This is across the board, across the UK. And it is, different airports have slightly different problems, but it's basically the same issues. It's ground handling staff, it's ticket desk staff. It goes across the board. In the States, there's pilot shortages and other issues, so different regions having different problems, but it is a problem that is going to face the entire industry across this summer. Then you may end up seeing a significant drop-off in demand. And that's the big question that everybody's trying to ask themselves here. When you get into fall, when you get into autumn, what happens? Does that demand drop off? They're trying to ramp up quickly, then does the demand drop off and leave them high and dry in that situation as well? Exactly the opposite of where they find themselves now. So there's huge problems. If you take a look at the short positions that are being built up in the airline sector right now, John, they are building and building and building.
What a mess. What a mess. Guy, great work, buddy. Looking forward to your coverage a little bit later this morning when Guy Johnson runs you through the European close. TK, go on.
One stop. You can get from Edinburgh to Naples with one stop. It's
Thanks for letting me know.
Stop, but,
is that my update for getting to Italy?
Right now.
What Guy just said then, working out the appropriate capacity at some point in the future is a difficult thing to do, and we've seen that with the retailers over the last couple of years, haven't we?
Forget we're coming out of a once-in-a-lifetime medical crisis that many would say we're still in. Right now, for Global Wall Street, as you are fixated on dollar DXY through 108, the euro, forget about the parity silliness. Euro Swissy popping right down on a 0.98 is the guy with the single most important concept out there with a major hat tip to David Rosenberg of David Rosenberg Research Toronto. Ian Shepherdson at Pantheon is looking at core inflation. Ian, why should we pay attention to core CPI?
Well, partly because it's the stuff that's not so affected by the pandemic. So a lot of the headline inflation numbers, whether you're looking at rents, which obviously have gone crazy, airline fares, super crazy, hotel room rates, car prices, all of which have been massively distorted by COVID. So the idea of a core number is it looks behind all that noise and says, well, what's really going on in the guts of the inflation story? Because that's what will be there when all this COVID stuff eventually drops away. And what's driving that core story mostly is wage growth. Now, remember this time last year, we were talking about frantic wage growth and a super tight labor market and really getting worried about the idea of a wage price spiral. It spooked the Fed late last year. And now, looking at the same numbers, the picture is really very different. Wage growth has slowed quite a lot, and already that is feeding into smaller month-to-month prints in the core CPI. So it's too early to crack open the champagne, and we've still got too many big distortions to the upside from COVID. But looking behind all that noise and saying, okay, where will we be in 6, 9, 12 months' time? These numbers are really encouraging to me, and I think there's every chance that they continue.
But Ian, to Tom's point, core CPI has lost a little bit of its potency at a time when people are worried about inflation expectations. Even Fed Chair Jay Powell came out and said, look, we can't be too nuanced about this because at the end of the day, it's what people feel every day, and it's happened for long enough that you're starting to see inflation expectations creep up, notwithstanding the data necessarily over the longer term that we got yesterday from the New York Fed. So how do you push back against that? That yes, core CPI used to be important, but is less so now?
Yeah, I don't buy that for a second. I mean, the thing about expectations is why do we care about inflation expectations? Why do we care when anybody thinks about anything? We care because of the way that it might translate into action. And the action that we care about is higher wage demands. So if you have a situation where headline inflation has shot up, expectations have shot up as well, and as a result of that, people are seeking and are extracting bigger wage increases from their employers, then you've got the danger of a wage price spiral like in the 1970s, which, as we all know, was a horrendous nightmare and took a long, long time to fix. But there's no sign of that at all, none at all. I mean, you know, wage growth over the last few months has averaged about 4% in the US, so only slightly higher than we saw at the end of the last normal economic cycle, and actually quite a sustainable pace if productivity growth is around 2. So I'm quite happy with that. It was very different a year ago, no question about that. Wage growth was 6.5, and at that point it was very scary. And if it had continued, or heaven forbid, had accelerated further, the Fed would have been in absolute panic mode long before now. But that didn't happen. What's happened instead is that labour supply has picked up, participation has risen, a lot of people have come back into the labour force, wage growth has moderated. You can see that already already in the core CPI, and the fear of an expectations-driven spiral is just not justified anymore. It was a risk, but it's not there.
And Ian, as we were just talking about with Guy Johnson over the United Kingdom about Heathrow, there is a concern about the other way. All of these companies building up capacity right now in the face of some of the distortions in the heels of the pandemic, only to be met with a lack of demand very quickly in the next couple of months. How much are you worried, or how much do you expect this sort of disinflationary force from that overcapacity that's being built up right now?
Yeah, this is a big deal. I mean, especially in the goods market, where we can see now inventories in some sectors are way above where they were before COVID. I mean, massively in some cases. So having had a story of a gigantic margin expansion driving up core inflation over the last 18 months, I think the story for the next year is gigantic margin compression from really extraordinary levels, which obviously poses a question for equity investors because of earnings compression. But from the Fed's perspective, from market perspective, what it means is that the pace of disinflation over the next year, I think, is likely to be quite a lot quicker than markets expect, because it's not just about a gradual slowdown and easing of wage pressure. It's about the potential for an absolute collapse in margins. And some margins, you know, car dealers' margins are 3 times higher than they were before the pandemic. There's no way on earth that's remotely sustainable. The only question is just how fast they fall. And if they fall very quickly, you could see core inflation in the U.S. returning to target next spring, easily.
Ian, one final question very quickly here. Pantheon has a unique focus on the Pacific Rim. Are we seeing butterfly effect right now? Are we seeing butterflies flapping abroad as we focus on euro? Are we missing the EM unravel?
I'm not sure unravel. You know, we've had a very tough period in China, that's for sure. But the EM Asia picture is not one of uniform grimness, that's for sure. There's some bright spots there. And certainly some of the China data are improving looking forward. I mean, looking back, we get second quarter GDP numbers this week. They're going to be terrible. But that's, you know, ancient history now. That stretches back to, you know, to April, when things were very different. So we are certainly not bullish, but, you know, it's not catastrophic. And some of the forward-looking surveys have certainly popped higher. So that's a relief to everybody else, but only at the margin. Really, the Euro story is about Europe, the US story is about the US primarily.
Ian, awesome to catch up. Enjoyed the research over the weekend. My thanks to you and the whole of the team over at Pantheon Macroeconomics. Ian Shepherdson there. And to what Ian was talking about, in certain parts of this market is betting against inflation and betting on slower growth. And Lisa, the perfect pocket of this market to look at in fixed income that captures that is break-evens. Break-evens basically near the lows of the year. And it doesn't really get talked much about.
Yeah, I was looking actually this morning. I'm really glad that you mentioned that at the five-year break-even rates. And this is basically a measure of market expectations for inflation over the next 5 to 10 years at 2%. They're right there at the target. They're basically saying the Fed's going to get there. And as you said, have been trending lower. Basically conviction the Fed's going to get what they want, and that there is going to be enough disinflation to get the market there as well.
At what price do they have to pay to get it there? And that's what this market is figuring out. Futures down 0.6% on the S&P from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The world has never witnessed such a major energy crisis in terms of its depth and its complexity. We might not have seen the worst of it yet.
Fanny B-Roll there, the IEA Executive Director from New York City this morning. Good morning. Futures negative 24. We're down 0.6% on the S&P 500. On the Nasdaq 100, we're down by 0.4%. Yields coming in 7 basis points on a 10-year, 292.25 on 10s. We were down 9 basis points yesterday on the session. So we add to that move low. We're going into CPI tomorrow. Just want to reflect on the words of the French Finance Minister, the Economy Minister, Bruno Le Maire, Tom, to echo what Fanny B-Roll just said there, that we should probably get ready for a total shutdown of Russian gas supply. And this may well be the most likely event. And that's the fear behind some of these moves we see in FX with euro dollar. Well, within striking distance of parity.
And I went through the coal complex today, and you're seeing it, John, not only in the very visible FX and the move to parity, 1.0012 right now, but John, I'm sorry, it's mirrored in what I'm going to call usable commodities, copper, Newcastle coal, Rotterdam coal, AJA, I think ARA. I mean, there it is. They're moving.
Yeah, the capacity constraints on Heathrow, Tom, I wonder how much more you're going to see that across economies in Europe for different reasons. That was about access to staff, labour. What about energy?
Well, you know, we'll see about energy as well, and maybe that's the next step here. You know, to be honest, Brent crude is relatively quiescent from 124 down to 104. John, some headlines on Spain, which harken back to our conversation with Dr. Boucher the other day. Spain to impose exceptional tax on banks, the Prime Minister says.
Yeah, new tax on banks for 2 years, Tom. I haven't got the details on this bank tax, so when I get them, I'll bring them to you.
In the boom economy, there we go. Right now, Ellen Wald with a senior fellow at Atlantic Council on oil, on strong dollar, which harkens back to another time and place, and petrodollars. Ellen, what does a strong dollar mean for your oil world?
Yeah, it's, things are quite incredible in oil right now, and as we're seeing, prices are going on a rather almost like a roller coaster, up and down. Fears of recession tend to send the prices down because there's a sense that this will reduce demand, but then the next thing you hear is demand is so strong still, and so then you see prices going up. I think that the news of Heathrow reducing capacity could actually, or putting capacity limits, the idea that could potentially reverberate across other airports could put a damper on travel and jet fuel demand as well.
Is there a linkage of petrodollars to declining oil demand?
That's a really good question. And I think at this point, we're not really seeing a drop in demand. We've looked at gasoline stats. Some weeks we're seeing a drop and other weeks we're seeing an increase. So I think that we have seen some declines in terms of demand destruction, but not a whole lot. There's a lot of pent-up demand. It doesn't seem like the dollar's really affecting demand all that much at this point.
Ellen, which raises a question of when we're going to see a pop in oil prices, given that even Fatih Birol, as we were just hearing from the IEA, came out and said this is a global energy crisis in a sense that we have never seen before in terms of complexity and speed. When do we see that translate into the higher prices that so many people are expecting and that, frankly, you're seeing in the physical market?
It's so interesting because we're seeing a lot of calls for either, oil will either go to $238 a barrel, or it could go down to $60 a barrel. And that's a huge margin here. And I do think that it reflects a lot of the uncertainty. And Fatih Birol is correct to call attention to a lot of the issues that we're seeing today. I mean, look at what happened in Sri Lanka. That could be next for many more countries, and not just developing nations, but we could absolutely see fuel crises around the globe. And part of that is due to historically low investment in fossil fuels, and that trend is not really reversing itself at any point. And this is precipitating a huge energy crisis.
Ellen, does any part of the capping of energy prices from Russia, or at least the energy prices that they receive, does it make sense to you in terms of its feasibility and a rollout and getting everyone on board? Or is this basically highlighting the lack of tools right now available to really curtail the crisis that people are talking about?
Yeah, I just don't see how imposing a cap on Russian oil prices is at all feasible, because, say you even get India and China, which are the biggest buyers of Russian crude right now, you say to them, okay, only pay this amount for Russian crude. And the idea is that India and China will want to pay less. Of course they want to pay less, but will the Russians want to sell them for less? Russia's holding the cards right now, because if India and China want their oil, they can say, sorry, we're not going to sell it for $40 under the benchmark. We're offering you a $20 discount. And are India and China really going to say no? Are they going to risk, especially India, having a fuel crisis in their country just because the West is saying we want you to cap the price of Russian oil so that it'll hurt Putin in his war against Ukraine? They're probably looking at saying, Ukraine what?
Ellen, you just mentioned Sri Lanka, and I'm very curious about the contagion effect here. When a given poorer country, beleaguered by high oil prices, provides subsidies domestically, where do they get that money? Do they issue debt, or is it a bailout from the IMF?
I'm guessing that they first issue debt and then they're hoping for a bailout from the IMF. And if that's not, coming, then they're going to see some serious problems. And we're seeing not just, developing countries do this, but we're seeing it in more developed countries as well, offering these kind of subsidies or trying to subsidize or cap energy prices. And in some cases, they're saying to the utilities, you can't charge more than X. Well, if the utilities have to pay more than X for their fuel, then that's just going to put the utilities in a bankruptcy situation. and likely cause them to be nationalized, and then the government's going to take that debt, and so on and so forth. So they're not really solving the problem. They're just kind of kicking it to other people or to other entities.
Ellen Wald of the Atlantic Council. Ellen, thank you. Thank you so much. And TK, we've got a real problem in Europe, to say the least, and it could get a whole lot worse year end.
No, we do. In oil there, Ellen Wald single-handedly moving the market, John. Brent crude from near 105 now, absolutely cratering. Can I get an intraday up, Qantas, of Brent crude 102.91 right now? It's simple, John. Oil in free fall.
We're calling our Australian producer Qantas again this morning.
Well, we are. It's a famous family Indian name. It's, a little bit Aborigine, although it's more of an Eastern phrase than a Western phrase like you'd see out at Perth.
You dig yourself out of that hole in a moment.
Will, thank you.
Lisa, you've talked about betting against inflation, betting on slower growth. Crude, down 4%.
At what point does this translate into what we're actually seeing on the ground? And Ellen really highlighted that, because we're not seeing demand go down all that much, as evidenced by the enforced Heathrow ban and enough people coming, on as many people as want to come to the airport.
We're seeing equities go down. We're down 0.7% on S&P 500 futures. Coming up, Anna Han of Wells Fargo from New York. This is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale, as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a currency and bond-driven market right now.
The market currently is already pricing in rate cuts next year. That might just be way too soon.
We are heading for some kind of a financial accident.
The Goldilocks outcome is now off the table.
I would be very, very surprised if we went into a new bull market anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a market this morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 0.8%. TK crude breaking down by 4.5%, and a sizable bid again into the Treasury market.
We like to avoid inflammatory comments, but there it is, John. In the last 20 minutes, plunge is the operative term for Brent crude, a 102 level, West Texas under 100. But it's more than that, John. It's a correlation's over. And things are tightly correlated this morning, and that the 2-10 spread, good morning Priya Misra, with that shocking 50 basis point inversion call. We just printed a negative 10 basis points, historically back to the Volcker era, John. That's a big deal.
Down 8 basis points on a 10-year, 291. And Tom, this is happening. Treasury yields lower yesterday, again this morning. This is happening going into CPI tomorrow.
We're going to talk about it with Anna Hahn here, and, you know, she and I will get mathy on us about tail risk and that. But the tail risks are adjusting this morning, John, and what's so important on the Bloomberg screen on the launch pad, the correlative nature of this is extremely different than a week ago.
Lisa, Europe, we have a problem.
And it definitely is hinged on what's going on with the oil markets, but also this idea that you are coming out of a pandemic to a new crisis, and how do you adjust? And I keep going back to this Heathrow story because it's both an oil story and it's also an economic growth story. How much do you have to curtail growth, curtail economic momentum because of a lack of staff and because of high energy prices?
A supply side story. If you're just tuning in on TV and radio, Heathrow in the last hour announcing a passenger cap through the airport, limiting daily traffic to 100,000 people through September 11th. And Tom, it comes down to getting the new recruits through the training, through security clearance, onboarding them, and this stuff takes a while.
Let's remember, John, that, you know, most of us are traveling fancy class. There's some real agony out there, and I would suggest that this is about individual stories that Heathrow has confronted where they said, this can't happen on our watch.
Should have seen Lisa's face then. Speak for yourself. Big shrug from Bramo. Speak for yourself.
I'm sorry. After being in, you know, most of us are traveling in fancy class. I don't know that I would agree with that statement, but I do think that this is something very real, focusing on everyone from the front to the back of the
Stop selling tickets is the message from Heathrow Airport to the airlines this morning. That's a supply side story. Lisa, you wonder if this extends to other parts of the economy. Not for America so much, but for Europe as we get deeper through the summer and deeper towards a long, long winter, perhaps, for this European economy.
Yeah, and you were grappling with the same questions that I was. What does this do to price? If you artificially constrain the supply that you have of tickets, then does the price go up? Does the demand persist? Or do you start to see a sort of crash where people aren't getting employed and they can't go and they buy tickets? I mean, at what point does this even out? And how does it do that without causing an even bigger price shock before the fall?
Lots still to come this week. We've got CPI tomorrow, bank earnings on Thursday, you, Mitch, on Friday, retail sales, take your pick. Futures are down. We're lower by 0.75% on the S&P. On the Nasdaq 100, we're down by 0.5%. We've talked about that move in treasuries, yields down 8 basis points. That move in crude, WTI negative 5 percentage points. And euro dollar, a bounce off parity. Lisa, back to 1.0022. A euro that's negative 0.2%.
Yeah, and how much does this really hinge on oil and gas prices? And perhaps this is a bit trading in tandem a little bit. And again, I'm totally speculating, but with the price of oil and gas, if there is a concern that higher oil and gas prices are going to lead to a more significant issue for the euro, especially ahead of what we expect from a potential decision from Russia on gas supplies. Today on the oil market, we do get any minute now the OPEC monthly oil market report. How much they talk about the supply and demand dynamic actually confirming what we're seeing in the market, which is prices below $100 a barrel in WTI and above 101.81 if you look at Brent. We'll be parsing through that. Also, 12:30 p.m., Richmond Fed President Tom Barkin will be giving a speech. How much does he talk about what his threshold is in terms of the CPI numbers that come out tomorrow in order to go 75 basis points, not only this month, but also in September? consumer versus perhaps not the most data point to watch, most important one to watch, and instead look forward to the University of Michigan inflation expectations that we get on Friday. And at 1 p.m., the U.S. is selling $33 billion of 10-year notes. John, I want to understand how much this demand into the Treasury market, particularly the longer end, persists, especially as you were noting, we're seeing a real collapse in the yield curve. It's now -10. It's the most negative, the most inverted, going back to 2007.
Unreal moves. Bramo, thank you. Crude, a break of 100 on WTI, back to 99. We're down by 4.9%. Let's call it -5, Tom. Brent crude down by 4.7. We're at 102.
Well, yeah, we are. And you mentioned Brent crude, but I would go back to currencies here as a litmus paper of the system, John, as you mentioned, tied into commodities this morning. And I'm sorry, it is jump condition Tuesday. I mentioned it before. These EM currencies, John, I'm getting two opinions here. One is it doesn't matter. And the other is, oh, yeah, look at that. Whether it's Philippine, Thai baht, on and on. Mexican peso getting out near 21. I'm sorry, EM is moving with strong dollar.
Tweet of the morning from Sam Rowe on Euro Dollar. Add on Twitter. Lisa, big win for travelers who are terrible at maths. Euro dollar parity. That's brilliant. That's brilliant.
Yeah, it is brilliant, especially if you look at some of the airline tickets and also all the
if you can
costs.
buy one now. If you can buy one. If you're trying to go through Heathrow to the continent, of course. Anna Han joining us now, equity strategist at Wells Fargo Securities. Anna, this volatility, this mess, whatever you want to call it, do we need to get comfortable, get used to it? Is it going to stick with us for a while?
Well, I don't know if you can say comfortable, but we do think it's going to stick around, John. I think a lot of the volatility, we're going to continue to see somewhat of outlier moves on the day. Aggressive rips up, aggressive drops down, and that's going to probably persist until we really see a sign from the Fed that they're easing off the gas pedal in terms of their hiking schedule.
Anna, your note is brilliant. It goes all Nassim Taleb, where you say, forget about the probability distribution, forget about the center tendency of kurtosis and such. Look at the tails, look at the tails. What does the left tail, the sweat of the left tail, the fear of the left tail, what's it look like right now?
Well, we would put it in context of really what sort of investment style we're thinking about. At the left tail, we're thinking about what have been the worst performers. What is that low momentum basket really signaling? And we have this kind of stress scenario, and what looks to be for us, base case of recession. You've heard it time and again, base case, base case. What's driving that? You're seeing these really poor performers be the broken stories here. And when you have that situation, we think that can persist. So to us, we're advising clients, avoid that low momentum basket. Don't go bottom fishing here. And also avoid the high risk basket and lean more towards that low volatility if you're worried about that recession. That's at least in the investment styles. But you also have to think of this in context of inflation. What are the potential drivers that might bring inflation off the boil? What are the extreme cases? And we don't see those extreme cases really relieving us of a CPI print below 8.5 for the rest of this year.
Inflation has been a story that a lot of people have been talking about and obsessing over for most of the year, but now it's the strong dollar and what that does to the S&P, to companies that derive about 30% of their revenues from overseas. How much of that has been baked in, and how much do you expect that to be really a headwind during this earnings season for what equity valuations do?
Well, Lisa, I don't think it's fully really baked in. Now, I wish I could pinpoint and put a number on it for you, but you bring up a great point. The dollar is strengthening, and that strengthening is coming from the different pace in which we are tightening monetary policy versus countries in comparison. And what that does to earnings, and already earnings and margins that are under pressure, it's going to add another weight to the U.S. corporate earnings season. And I think that in itself has caused some of that volatility we're talking about. People are worried, can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer? And that growth is going to be really what drives confidence in equities and what dictates the direction for the rest of the year.
Anna, the cause of a lot of this has been the energy industry and the price of crude, the price of energy, the price of gas. Do they become the victim of the solution? Can I be long those names into year end if I'm expecting that kind of GDP deceleration?
Well, I think there are ways to be exposed to the energy markets and play that carefully. But for us, we think on a broad scale, looking at oil and commodities, they may be peaking here. Now, that doesn't mean that they're going to be rolling over quickly or rolling over strong enough that CPI comes down aggressively. But we do think that in many instances and cases that we may be seeing the top here. And another aspect of that, and where we might see part of that being hinted at, is you look at how much the market believes that the impact of energy has on CPI might be reduced as you look at break-evens. You see break-evens rolling off from what had been above 300 basis points now down to maybe 370, 230, excuse me,
Yep.
230 basis points. Now that's telling you that it's starting to weaken as an impact, and that's where we're getting our signal that maybe oil and commodities really are reaching their peak.
Anna, awesome stuff, as always. Anna Han there of Wells Fargo Securities, thank you. Lisa, building on what we've been talking about over the last 60 minutes this morning.
Yeah, basically that you're seeing longer-term inflation expectations come down and even near-term ones. If you take a look over the next 5 years, how much is that bleeding into this belief that perhaps oil has already peaked, at least, or is near its peak, because you're going to see a decline in demand commensurate with any potential decline that we get in supplies.
I promised you I'd bring you the JP Morgan update from Marko Kolanovic over in the investment bank. He's gone from max bullish to kind of max bullish. We reduced the weight of corporate bonds and increased the weight of government bonds in our model portfolio. Our model portfolio's pro-risk stance refocuses on equities and commodities, with a credit underweight serving as a partial hedge in an adverse scenario. Tom, I went through the note yesterday afternoon. He is still singing a super bullish tune into year end.
He's got some company as well. It's been a remarkably gloomy week, but there's some people out there saying use this as an opportunity.
We'll catch up with Jim Paulson of the Luthold Whedon Capital Group in just a moment. Futures negative 0.7% on the S&P, yields lower by 8 basis points, and crude breaking down to 99. We're down 5%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The price of oil is falling again today. A COVID resurgence in China is adding to concerns about a global economic slowdown. Meanwhile, the White House says OPEC has room to raise production if President Biden's upcoming trip to the Middle East yields any agreements. One of the president's stops will be in Saudi Arabia. The Conservative Party wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. London's Heathrow Airport is moving to limit the recent travel chaos. It's asking airlines to stop selling tickets for summer travel. The biggest airport in the UK will limit daily passenger traffic to 100,000 people through September the 11th. Heathrow is scrambling to hire more staff and says new recruits aren't yet up to speed. And Peloton is taking one of the most dramatic steps yet to simplify operations and reduce costs. The company will quit building exercise bikes and treadmills at its own factories. Partners will now handle manufacturing. Peloton is making the change after several months of turmoil. The company cut nearly 3,000 employees earlier this year, and shares are down 75% in 2022. And it's the first time human beings have seen a distant galaxy cluster, as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that ultimately the price of oil or the Fed or maybe the strong dollar will lead us into a recession. And when the recession hits, which will be a 2023 event when it hits, not 2022, that the market will find the bottom somewhere between 35 and 40% below its peak of 4,800.
Really thoughtful stuff, and great to hear from Leon Cooperman there, the chairman and CEO of the Amiga Family Office from New York City this morning. Good morning with Tom Keene and Lisa Bramberts. I'm Jonathan Ferro. Here's the price action. We're down 0.7% on the S&P. We are negative 0.33% on the Nasdaq 100. Yields are traveling lower again, down by 8 basis points to 291.33. Crude with a 99 handle, down by 4.5%. Everywhere you look, there's a headline right now. Euro dollar approaching parity, bouncing back 1.0040, now unchanged on the session on the euro. The latest report out of OPEC, Tom, the first oil market outlook for 2023. Grant Smith here at Bloomberg writing this one up for us. No relief for squeezed consumers. More crude needed from the group, even though most members are already pumping flat out. OPEC expecting global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year.
Not necessarily, John, in order, but well, let's go through it right now before we get to Joe Matthew. We've got fears in Macau and Shanghai, variant 5, I think it is, shut down. We've got the horrific story in Europe with nat gas, coal through the moon, ideas of German slowdown, CZEW this morning. And then we just got a war still going on in Ukraine.
Yeah.
And I mean, the stew of this gets you to a point of crisis. How far are we from that?
China's underplayed this morning, Tom. I think it has been over the last few days.
48 hours, yeah.
As well. Yeah. Clearly, we're facing the prospect of increased restrictions across the country again, and clearly the commodity market is picking up on that. And we talked about Marko Kolanovic over at JP Morgan. If you read through his latest note, what he's looking for in the second half is a big rebound, not just in the market, but for global growth potentially too, led by China. China's a big issue in a lot of people's outlooks going into year-end, Tom.
Very quickly, as we talk of EM this morning, the JP Morgan EM FX index, which is a very, very solid index, in the last 10 years has weakened by 47%. That's just a stunning statistic. Of course, much of that recently. Joe Matthew knows this. He does Sound On. on Bloomberg Radio, required listen on a really good conversation each and every day. And he joins us this morning. I believe, Joe, it's Tuesday. That's about the only thing I can get my hands around this morning. The president awaits Riyadh. How much will Riyadh be about oil talk?
Boy, it depends who you ask. The White House has been really trying to tamp this down. They say it's more of a trip about security.
Exactly.
And, of course, the president wrote to that in his op-ed. The fact of the matter is, look, everybody knows that the president needs to get more oil pumped here, whether or not it will actually lower prices at the pump. But there is a different strategy here. So he doesn't look like he's going hat in hand, first of all, to Saudi Arabia. He's going to be asking OPEC producers as a whole to try to do their part and pump more. But if you think back to the Abraham Accords here and the fact that Israel has not normalized relations with Saudi Arabia, I think the White House, the president here, sees an opportunity. That's what they're going to try to strike as he becomes the first U.S. president to fly from Israel to Jeddah, from Israel to Saudi Arabia. There might be some talk about, and it could be incremental, but might be some talk about bringing Saudi Arabia into the fold there. And it means a lot more as we see Vladimir Putin now preparing a visit to Iran. There are a lot of different layers here. It's a very complicated trip from Israel to Saudi Arabia, and oil may only be part of the equation.
What is his best outcome, bringing that clear discussion, Joe, back to domestic politics?
Well, it has to do with refining capacity, right? If the president of the United States says, yeah, okay, look, we got more oil, but if the prices don't come down at the pump, then there's not much of a point to that, of course. Now, on the other hand, from a diplomatic standpoint, from a global peace standpoint, a security standpoint, sure, that would be an amazing story to tell, bringing the Israelis and the Saudis together, but it may not impact people's lives here in America in time for November.
Joe, when you talk about November, there was a poll yesterday out by the New York Times, Siena College, that found that 64% of Democrats want Joe Biden to step aside and let another candidate run for the Democratic ticket. Has he talked about this privately? What are you hearing in terms of who the frontrunner would be to take his spot?
Well, there isn't one, and that's why they're not talking about this too much. I don't think Joe Biden likes this conversation, although, you know, maybe when he wakes up in the morning, he thinks, God, I hope this is the only term. But let's keep in mind that the New York Times actually ran numbers on the Republican side as well and show that Ron DeSantis, the governor of Florida, is actually running a pretty good challenge to Donald Trump as a potential candidate in 2024 here. Look, it's really early to be running these numbers. And when you think about it from a generic polling standpoint, you put Joe Biden up against an unnamed Republican, you're going to get one number. If you name Donald Trump, Joe Biden frequently leads those polls. That's also because Donald Trump's numbers have come down. So this is a pretty complicated situation. You are starting to see some folks like Governor Gavin Newsom stand up here, but I don't think there's an heir apparent, if that's what you're asking.
The reason why this is important is people are trying to get their hands around what fiscal policy will look like, especially as we head into what could potentially be some sort of recession that a lot of people are gaming out. We have certain fiscal plans certainly hanging out there. How much cohesion is there to get anything through if there isn't necessarily a frontrunner of the party, as evidenced by this poll?
Well, look, until we get further down the road, it's in Joe Biden's interest to make it clear that he could run, at least could run for a second term. If you have 2 years of lame duck coming, you're not going to get anything done here. So the president will keep his head down on this. The question that a lot of people have is what happens to Kamala Harris? When is the last time we saw a sitting vice president not be considered for the job at the end of this term? And we may start seeing more of her. We're starting to see her do more interviews, more media. I wonder if she becomes a more prominent and visible member of this administration post-midterms.
Joe Matthew, thank you, sir. Looking forward to the program on Bloomberg Radio a little bit later. Sound on weekdays at 5 p.m. Eastern Time. Must listen a little bit later on some big issues. Big issue for us this morning. This cap at Heathrow is fascinating. So they've introduced a limit on daily passenger traffic to 100,000 through September 11th. Effectively, they're telling the airlines, stop selling tickets this summer. Mohammed Al-Arian writing out on Twitter, and Lisa, we've picked up on this theme. He said, albeit an extreme case, this is a useful illustration of how persistent supply dislocations can lower demand yet keep inflation high. That's what we talked about with Guy Johnson in London. You can limit capacity. What's going to happen to ticket prices elsewhere?
Exactly. People are going to want to travel. People still want to go on vacation. They still want to see family. They're going to look for a place where they can get that ticket. I mean, again, if you try to constrain supply, that's only going to lead prices to go higher, at least in the near term, before the trickle-out effects of the economic fall-through really take place. It really is a conundrum highlighting this pain point we could be heading into.
As Mohammed says, there's an extreme case. But how exceptional will it be, TK, through the rest of this summer, through the rest of this year? We're going to see other things like this.
We'll see other things. There's no question in my mind about it. It's going to be wildly uneven. And one thing I can say, John, is the polarity between what the United States is doing and other nations is really stark. The U.S. is distinctly different going into the third quarter.
Futures right now, negative 0.5% on the S&P. On the Nasdaq 100, we are lower by just 0.1%. Not as bad. Crude rolling over, down by 4.5%, 99.40 on WTI. From New York, this is Bloomberg.
Connection lost.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
If you were looking for a bounce, it's not a great start to the week. Yesterday, not fantastic, very defensive. This morning, softer again. The S&P negative 0.5% on the Nasdaq 100, down about 0.1%. Muted price action on the Nasdaq, a gap lower on the S&P, and a little bit of a bounce off the lows in the last 20 minutes or so. The bond market picture reflected what you're seeing in the equity market story. 2s, 10s, and 30s, yields come in lower, down by 7 basis points on a 10-year, down aggressively yesterday too, to 291.89, going into a CPI print tomorrow, and we hope again, I think for the third straight month, that we may have seen a mechanical peak in year-over-year inflation. 8.8% is the estimate so far in the Bloomberg survey, Tom.
The core matters
Core is expected to come in just a little bit.
Yeah.
But can you eat core, Tom?
No. And Elarian had a great tweet out about that. No, I had a great tweet out. John, we got to state here on Global Wall Street that the currency market's not as upset as it was 2 hours ago.
Bit of a bounce off parity on euro dollar. I want to focus on commodities because there has been a breakdown this morning on Brent, on WTI. Brent down by 3 or 4 percentage points right now to 103. Just a little bit of a move off the lows in the last 20 minutes or so, along with equities. The move on copper, though, down by 2.3%. Goldman Sachs saying 6,700. That's a big revision lower on their price target into year-end for them, Tom. And they think that could come in the next couple of months. 74.17 right now on copper. Global growth concerns, Tom, at the epicenter of this market. Bramo said it earlier. Market's been betting against inflation, betting on slower growth.
John, we need to be flexible. That's all there is to it here. And for me, the Heathrow solution is you've got to be creative. I mean, if you're going to fly to Crete, you don't go through Heathrow anymore. You go Newark to Geneva, and then you go from Geneva into Heraklion Airport, which is not the main airport, but it's like good enough for Crete.
Are you Lisa's travel agent?
Yeah, I'm just
preparing her flights for
Geneva, Switzerland looks
this
good.
Weekend. Yeah. On a serious point, Tom, I really wonder what's going to happen with these airlines in Heathrow. If you've introduced a passenger cab, do they incentivize some people who got cheaper tickets to cancel? Do they have to move people around, cut their own flights to make sure that all the flights that are flown are full? It's going to be very interesting to see what they do in the coming weeks.
And then more importantly, American Airlines just out second quarter revenue up 12%. I mean, the fact is the seats are full and we're paying ginormous dollars. I mean, they're minting money.
I've got skin in the game. That's the reason I bring this up. If you'd like to take my August flight and incentivize me for cancelling that so you can sell it for more, I'm all ears. Going to be interested to see what they do. That's your cross-asset price action. Let's get to Bramo for some single names. Hey, Lisa.
Hey, this is the reason why I'm going to skip the flights to Crete and just simply drive up to Tupper Lake to do some portaging. Gap shares. I'm really focused on a bunch of different movers, including Gap, after they fired their chief executive officer, Sonia Singhal. She had come in 2020 to turn this company around. Gap shares down more than 50% year to date and down almost 6% in pre-market trading. What will it take to turn around a company that has struggled both with concept and now in the face of a lack of consumer demand for basic goods simply because of the inflationary headwinds? Bed Bath & Beyond, another laggard in the retail space, shares down more than 60% year to date, shares down about 0.2% in pre-market trading. But I point to Bed Bath & Beyond because they also saw an ouster of their CEO not so long ago. How much can a new person revive a retailer in such a different and difficult environment for them? And Amazon I'm pointing to because they have, of course, their Prime Day, which I'm only mentioning for you, Tom. Does anyone actually care about this stuff? I mean, is it just basically a marketing ploy?
I've never done it. I think it's
You've never done Prime Day?
No,
Are you into Prime Day?
I think, Lisa, you're dead on. It's just a ploy. What the bet here into earnings is what are they doing to right-size the cost that Bezos put on as he was going out the door? That's a 2-minute drill.
All right. Well, thank you. And I think that there are a lot of people who are probably participating in Prime Day.
But it is. I want 100 tablets, 100 tablets, dishwasher tablets. Usually they do you a nice offer.
Tablets? I thought you were talking about iPads, so that you're buying 100 iPads.
Much money. Dishwasher tablets. I'm looking now to see what the sale is.
All right.
Thanks for reminding me.
Anytime. Put in your orders right now. I'm also looking at a number of potential winners, even amid this very difficult situation. I point to Pepsi in particular. They came out with guidance for the year ahead, upgrading for the second quarter in a row. Their expectations for profits up 0.8% in pre-market trading. Peloton up a whole 1% after saying that they were going to move their manufacturing of their bikes products and other supplies to other partners and not make it in-house in an effort to really simplify. American Express, and John, this goes to a story that you've been talking about, down 2.5% after Morgan Stanley downgraded their expectations for the company. Why? Because of consumer spending and a pullback away from oil and gas. Exactly that Bank of America report you were talking about some of the card spending and what you're seeing in terms of the breakdown.
Yeah, a ton of price target cuts on some of the financials from Betsy Graysick this morning over at Morgan Stanley. Lisa, thank you.
I missed that. What'd Betsy do?
Cut price targets, Tom, and a ton of financials. Yeah. The banks ahead of earnings. Still priced in with her price targets at the moment. Some decent upside for some big names. Building on what Lisa said, though, on the consumer situation, the New York Fed put out their June consumer expectations survey. Short-term inflation expectations up. Medium long-term inflation expectations down, but here's the kicker. Home price expectations lower. Spending expectations lower. Credit access perceptions lower. Household financial situation deteriorating. Just tick, tick, tick right across the board, Tom. Not what you want to hear.
Extraordinary to see. On the Amazon Prime Day, to close the loop, I'm looking at the Zonfaz solid bow ties.
So you are looking.
Self-tied for Tuxedo, down 27% on that as well. Kathy Jones with us, Chief Fixed Income Strategist at Charles Schwab. Is the great mystery here, Kathy, that we're going to want to be in fixed income with price up, yield lower?
Yeah, I think that the time to move into a little bit more duration has come, and we've been suggesting that for a little while now. You know, when you get 10-year yields above 3%, especially up in that 3.5% area at a time when the Fed is tightening and the economy, the global economy, is under a lot of stress. I think that safe haven move and that yield move is the way to go.
Kathy, Anna Hahn was on with a wonderful discussion of the tail risk out there off kurtosis. We rarely talk about tail risk in the bond market. I want to go there right now. How uncertain is the determination of what price will do in fixed income now? How malleable are the tail risks of the bond market?
Yeah, it's a great question, Tom. I think the question is, where in the bond market are we talking about? So we still see a lot of tail risk in credit, particularly lower quality credit, high yield, and even in the private debt markets, there's a building amount of stress there. So I think the tail risk there is pretty high. I think in treasuries, obviously there's some. I don't think it's immense anymore, simply because we've had such a massive upward parallel shift in the yield curve, and we've got the Fed tightening. That combination typically will, flatten the yield curve, invert the yield curve, and so that probably diminishes some of the tail risk at the long end.
Kathy, we were talking earlier about Marko Kolanovic being an uber bull and moving to being just a bull when it comes to risk assets. If you look at his note, it's actually really nuanced, and he has a pretty bold call on credit, saying that is not pricing in as much risk right now as stocks. Would you agree with that?
Well, I don't do stocks, so I can't compare the two, but I will say I think credit still has some a ways to go in terms of pricing in recessionary conditions for a further deterioration in credit quality and credit performance, both domestically and globally. So when we look at the high yield spread, it's moved up quite a bit, but we think it can move up another 150 basis points or so if we get into a pretty sharp downturn here, which it looks like that's where we're headed towards the second half of the year.
Which sounds like it could be controlled or it could be uncontrolled based on the pace of it. And I think about what Michael Shaul said yesterday on the show, where he was saying that we could start to see real market dysfunction that could actually get the Fed's attention. Do you see corporate credit as being vulnerable to that type of fissure that he's talking about?
I think the problem in corporate credit is the liquidity issue. So yes, at the very low credit quality, we could run into some problems there, and I think access to the market would be really difficult, and probably is getting more difficult for, say, CCC rated, low rated corporate issuers. But I think in the investment grade space, what we worry about is just liquidity, because the dealers are not holding as much. The banks, the dealers are not holding as much. A lot of it has moved into the private market. If there is a dislocation, it's simply the inability for the market to get the liquidity it needs to get the price and yield right. So we could see some problems there. We're not anticipating it, but it certainly could happen if things deteriorate quickly.
Kathy, thank you. Always wonderful to catch up with you. One of our favourites, Kathy Jones there of Charles Schwab. The tone of this equity market improves a bit. We're down 0.4 on the S&P, with positive 0.1% now on the NASDAQ, but capturing some of the tension in the bond market. The distance between a 2-year yield and a 10-year yield, Tom, is negative 10 basis points this morning.
Yeah, it's real simple. It is back to the great financial crisis. And I'm not comparing the two, John. I think the situation right now is radically different, particularly given leverage. But the fact of the matter is this bears watching. Let's walk through it, John. The 10-year yield as compared to the 2-year yield is the vanilla spread. There's 47 other spreads out there. Lisa's got them all memorized. I don't. And the answer is the 2-year yield is higher than the 10-year yield. So you go through zero and down you go. And the amountedness of it is a huge deal. 10 basis points of inversion is a different story than 3 basis points of inversion.
When you are willing to accept a lower yield on a longer dated maturity than a short-term maturity, Lisa, typically that signals some kind of problem.
And as you cited earlier, it just really is a question of how we get there. Is the path going to be gradual? Is it going to be controlled? Or is it going to be violent? Is it going to be something that's much more significant when it comes to both the market and economic disruption? And that, as you said earlier, and as Tom has been talking about, is what the market is trying to figure out right now.
That's the bond market. We need to talk about the foreign exchange market. Jordan Rochester of Nomura was looking for that move to parity. We're basically there. He is factoring in some dollar strength and maybe some more. We'll catch up with him next on this program. From New York with Tom Keene, with Lisa Abramowitz, I'm Jonathan Ferro. Futures negative 1/3%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. OPEC's first oil market outlook for 2023 has been released, and it suggests no relief for squeezed consumers. The cartel expects global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year, but members already are falling far behind the volumes needed right now. In the UK, retailers reported another drop in sales. Record high inflation is keeping consumers from spending on discretionary products and services. The British Retail Consortium measure of sales fell by 1.3% last month from a year ago. In Shanghai, there are fears the city is heading back into lockdown a little more than 5 weeks after exiting a 2-month ordeal. The city reported 59 new coronavirus cases on Monday. That's the 4th day in a row that case numbers have been above 50. The detection of a new substrain of the Omicron variant triggered 2 more rounds of mass testing in Shanghai. And Croatia will become the 20th country to adopt the euro. The EU gave its final approval today, recommending that the Adriatic nation of 3.9 million people be allowed to begin using the common currency. Croatia is the first euro newcomer since Lithuania back in 2015. And PepsiCo's raised its outlook for the 2nd quarter in a row. The maker of Mountain Dew, Fritos, and Quaker Oats expects revenue to grow 10% this year as consumer demand remains resilient. PepsiCo's North American food and beverage business remained strong during the quarter. Meanwhile, demand for convenient foods helped international markets continue to perform. And it is the first time human beings have seen a distant galaxy cluster as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
When you look at how much the euro has overshot in the past, we've come up with a range of anywhere between 95 and parity. And I think in the current environment, that sort of range is not really unreasonable.
George Saravelos, the global head of FX research at Deutsche Bank, seemingly everyone on board with this story now, looking for a weaker euro. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro looking at futures with a bit of a bounce. We're negative 0.5% on the S&P. Yields lower by 7 basis points on the day on a 10-year. Crude at 99, down by 4.75%. And euro dollar, let's just call it parity. Jordan Rochester of Nomura, Tom, looking for 95 by the end of August. More pain to come for that currency pair.
When we invented Bloomberg surveillance, folks, it's about bringing in the experts, John. And what I think we can say, John, is Jordan Rochester at Nomura is nuanced and different than George Saravelos at Deutsche Bank, is nuanced and different than the giant Stephen Englander over at Standard Chartered. And to talk to all those people, to read their research, helps us collate around this shock that we have.
Should we bring in Jordan Rochester right now?
You bring him in right now. You bring him in right
Jordan,
now.
where'd you get the extra downside from on euro dollar from where we are down to, say, 95 in August?
Morning, everyone. Afternoon, everyone. Well, in terms of why we think euro carries on, the risk is, of course, these gas flows, but there's also a global recession story building up. So I think most analysts have now only just realized euro can keep heading lower. There was actually quite a bit of a fight in the sort of sell side community around the 106 level when the ECB turned hawkish. Well, now it's quite clear the gas flows are dominating. And the reason it goes to 95 is probably 3 reasons. The first one is the gas flows. We think that there's a high chance that Nord Stream doesn't resume its operations. And what we're seeing is a fundamental macro story. Euro-dollar is heading lower because European importers of gas are buying whatever they can buy from the US, from Qatar, from Azerbaijan. They're just throwing money at the wall to make sure the EU achieves the 80% gas storage aims. They're roughly around 62 or 66% full. So they've got a lot more to do. And that's forced euro selling all the way until that target is reached.
Jordan,
the second reason is China.
Okay, continue. Sorry. Continue.
The second reason is China. China's COVID business cycle. Before the break, we had a little first word there telling us that Shanghai might be going into lockdowns again. That's the biggest trading partner for the euro area. So demand has just come out of the curve for European exports. And the third one is recession risks. The US raising rates the way they have, the way the world has moved with the supply chain and inflation. The ECB is going to raise rates in July, September, October, and so on. But we're talking about rate cuts here at Nomura next year. I think that's the next trade. And I find it really interesting how there's so much Fed cuts priced for next year. The curve's inverted, but that hasn't happened in euro yet. So that's the next story, and that's going to weigh on euro as well. So it's not just all about gas flows. It's a bigger story.
2-cent spread moving from -10 to a -11 basis points. Get your attention. Jordan, you and I were weaned on reading Dooley, Folkerts, Landau, Garber. David Folkerts Landau over at the big German bank makes real clear at some point we have to step in. Using euro as a proxy, are we anywhere near on a Jordan Rochester 0.95 where institutions will step in to staunch the dollar strength?
It's definitely possible, but I think it's unlikely. It's definitely not my base case, I can say that. So when the euro was invented, there was FX intervention. That was the authorities around the world stepped in, the Federal Reserve, the Bank of England, and so on, to help support the currency so that it didn't spur a Eurozone crisis in its early infancy. So there was a joint effort there. And at the same time, inflation was not as much of a problem as it is today. Right now, every central bank around the world pretty much wants a stronger currency. It helps tame inflation from import costs. So that's why we're seeing even the likes of the S&B, who have for years fought the curve and tried to not have a stronger currency. They're pretty much asking for one. Well, the Eurozone, they can do that via rate hikes. And I think that's the main way they're going to possibly do that. But as I said earlier, the growth story is much bigger than just the rate hikes. There's what's going on with gas in China. But FX intervention is being talked about in Japan as well. Another great example. The authorities there say the move is detached from fundamentals, where most of the charts we look at say actually the move is quite in line with fundamentals. That's the same with the euro. We've had a huge terms of trade shock, Tom, and German exports have now become very uncompetitive. The cost of electricity and energy in Europe is roughly around 6 times higher than America. So to make a piece of manufactured equipment, you're paying 6 times more in electricity costs. You're uncompetitive versus an American firm. You need a weaker currency to help you out.
Jordan, I want to tease out the potential cases that you lay out in your most recent note. 95 is the most likely that you see by mid-August, or the end of August, I should say. That's according to your latest note. But you said that a 90 print could actually be reasonable to look for over the winter if we do get a Nord Stream 1 cut off, if Russia does not restore the gas supplies. At what point does something break? At what point is there a level at which you start to see a contagion that perhaps is not linear?
Well, I think 95 to 90 is non-linear. What breaks? Well, I think credit channels will be much more the area where things break. So the rise in interest rates we've seen and the drying up of consumer demand, we're going to see a lot of business models really challenged, and that's where you'll have something breaks. The irony of that is if you have credit spreads widen, that leads to a dovish central bank typically, and that would mean a lower euro. So I still think the exchange rate is the release valve, and I don't think the exchange rate is what's going to cause that stress. It's coming from the supply and the demand side of the equation when it comes to those risks. But look, when we get to 95, we're kind of basing that on the Nord Stream 1 flows maybe coming back to 40% of their capacity. What 90 cents is, that's the scenario where Nord Stream 1 does not come back on and the euro area does not get enough gas storage and the German manufacturers get their gas rationed. The Bundesbank in Germany have already done the analysis. They expect that's a 5% hit to German GDP if we have gas rationing. Outside of COVID, that's one of the biggest economic shocks we've ever seen. So that's a crisis. You need a weaker currency to help you out.
Jordan, just quickly, we've got to squeeze this in. We're rationing flights at Heathrow. Heathrow out this morning, basically putting a passenger limit on airlines through September 11th. What did you make of that? How important is that story for you?
It's the summer of discontent. For a lot of people, this is a personal story for their own lives. I'm flying next week. I'm flying with British Airways. So maybe this will disrupt my flights. But on a macro scale for the UK, it's going to lead to a summer of discontent. It could lead to higher wages, more broadly speaking, and that makes life trickier for the central banks. They're looking at high inflation, looking at rising wages. They should be raising rates in that scenario, but they're also seeing economic crisis building up in the future, in their pipeline, if we have, especially if the gas situation gets worse. So the central bank's in a really weird place. They need to raise rates to tame inflation, but they'll be looking at negative growth. So that summer of discontent just keeps central bank in that weird place.
What a tough spot. Jordan, thank you. Jordan Rochester there of Nomura. TK, the UK, Europe, things getting harder and harder, seemingly every morning at the moment.
Yeah, there's, in Europe, that's there, and there's all these micro stories. I like what El Arian said about little fires this morning.
You
John,
said that a few times, yeah.
To go to the other side of the world, Rebecca Chun-Wilkins out on Twitter for Bloomberg writing on property bonds. I don't know anything about this in China, but we're underplaying the stresses in China, as Mr. Rochester just talked about.
Couldn't agree more, Tom. We talked about that a few times this morning. The prospect of more COVID restrictions dragging down commodities too. Yeah. WTI 99.34. We're down by 4.6%. Coming up shortly, Jim Polson of Luthold Whedon Capital Management. Looking forward to that. Futures negative 0.5% from New York. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The sort of underlying economy, the labor market, obviously can withstand a fair amount more tightening, but financial markets here are wobbling.
I'm shocked that interest rates are as low as they are.
The action is in the currency market right now.
What we're seeing globally is essentially a huge hoarding of dollars from investors.
The big market call is much more volatility coming forward.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on Global Slowdown on radio, on television. Thank you for joining Global Wall Street and all of you concerned about this international slowdown. John, everywhere I look, that is a signal.
Yeah, and you see it in the FX market loud and clear over the last few weeks. Euro dollar moves we haven't seen since 2002, the worst year since 2001. And underpinning behind that move, Tom, as we know, is an energy issue, perhaps an energy crisis in Europe's future. Perhaps that's already here.
We see it with the death of ESG, coal moving out, Newcastle coal. We see it in Rotterdam coal as well. But, John, what I want to focus on in the last hour, we have curve inversion, the vanilla curve, 210s spread. For those of you keeping score at home, back to 2007.
It's been developing over the last few weeks, Tom. Negative 10 basis points. Your 10-year right now, 292, down 6 or 7 basis points. Yeah. We've had 2 big days for treasuries, Tom, going into CPI tomorrow. And some people think we could get very, very close to a 9 handle on headline CPI.
That's headline CPI, and then there's core CPI. Lisa, how do you focus on the inflation data tomorrow into what will occur in fixed income?
It doesn't seem like nuance is necessarily going to rule the day when you take a look at a headline number that could come in with a 9 handle at 9% year over year at some of the most extreme cases and predictions. If that's the case, you can expect people to start to price in 275 basis point rate hikes this month and then in September. When you talk about the core, maybe on the margins that could be used as an excuse, but the Fed chair himself has come out and said this is not a time for nuance when you have inflation at the hottest pace going back to 1981.
Yeah. John, Jordan Rochester tiptoed around it. I believe Steve Englander is scheduled to be with us as well. We're trying to bring you the best on Wall Street, folks. Jim Paulson to join on Equity Spirit here in a moment. But, John, do we have any idea of dollar strength and everyone else erosion when Lagarde and other institutions will step in? I don't have a handle on that.
Well, you tell me. Is a central bank rate hike from President Lagarde bullish or bearish for this currency, Tom? Can you answer that question? I can't answer that question.
I don't know. As I mentioned, it's Jump Condition Tuesday. And John, you bring over to EM. Everyone's telling us EM doesn't matter. I don't buy it.
EM matters, Tom. China matters more for this global economy. China matters more. Matters more to this commodity market too. We said it through this morning. We've underplayed that story. Many people have over the last few weeks. You can't make a call on this commodity market without a deep understanding, a better understanding of where the Chinese economy is going year end and whether President Xi moves out from this lockdown on, lockdown off story of the last 2 years.
Dollar renminbi to start the data check down, weaker, jump condition out 2 standard deviations in a narrow range, 6.72 yuan per dollar. And that shows not so much currency as a mechanism for China, John, but that there's an immediacy to their actions to stabilize their economy.
And let's whip through this price action. Crude lower off the back of some of this. Commodities softer. Copper heading south. Yields coming in 7 basis points. Tom talking about the difference between 2s and 10s, the distance between the two, negative 10 or 11 basis points. In the FX market, euro dollar 10038, and moments ago on this program, Jordan Rochester of Nomura talking up the prospect of hitting 95, Tom, and maybe going below that level, but acknowledging that any call on going south of 95 ultimately is a call on what happens with gas supply later this year.
It is, and the gas supply is a calendar item. John, how do you focus in the record heat that we're seeing now across continental Europe?
Brutal, Tom, brutal. and it's going to get harder and harder later this year. I think the more important factor right now for Europe is what happens with Nord Stream 1 when it comes back online, how much gas supply we get through that, Tom, and how much gas supply we get later this year. For the ECB, I keep going back to this, Tom. What's the optimal policy for the ECB? Is there one?
I don't know. I think they're making it up as they go.
Is there one? They meet next week. They meet next week. This is their world right now.
Yeah.
It's brutal, Tom.
I think it's brutal, and to John's point, folks, I would suggest so much of our economic theory and action now is being made up as we go. James Paulson joins us now, Chief Investment Officer, Luthold Whedon. He knows that Minnesota is not in drought, but off to the southwest, there is serious drought issues across farmland of America. Jim, let's start there. What is a symbol of what commodities are doing with the latest corn surge? How do you fold the Midwest commodity surge into the mix of investment dynamics?
Well, you know, I think that I've always said, I grew up in Iowa, Tom, and I always said that Iowans are related to Texans in a country that likes disinflation. And actually, inflation, it always did good for the Iowa economy, and it always has done good for the rural Minnesota economy, and as well as like Texas, but much of the rest of the country does better without it. And there's a lot of rural America that's benefited greatly from the rise in commodity prices in general, and they'll start to feel the pinch, again if it comes off. Which I think it is. I think it's already starting to go that way. But it's always kind of been a situation where you're an inflation business in a disinflationary country. You always feel a little bit foreign, if you will, overall.
Jim, we've all been told once or twice over the years that you should seek discomfort in markets. That's where the big returns are. Are you ready to get uncomfortable or comfortable where the discomfort is right now?
I've been uncomfortable for a while already, Jonathan. This is the bear market that won't end. So I don't have to get uncomfortable. I've been there already. It just seems clear to me that if you look at the stock market, it's going to need to some inkling that the tightening monetary and fiscal tightening packages deployed across the world, particularly the United States, has got to come to an end, and to see some end in that. And I think we're getting closer than we think. I really do. I look at the Fed, and I think it takes its direction from its boss, just like you and me do. And its boss is the economy and the bond market, in my view. And right now, I think there's a pretty consistent message coming from the Fed's bosses that they need to think about wrapping this tightening cycle up. If you look at real growth, you were just talking about global growth really slowing. It certainly has here in the United States. The economic surprise index is the lowest it's been in this recovery. The GDP now number looks like another negative print for the second quarter. Real growth has certainly slowed dramatically. That's saying that that economic growth boss is telling the Fed it better wrap this up. I think on the inflation front, I think we're winning the war. I know we're going to get a hot print tomorrow due to energy, but we also know that the next couple months after that, we're going to get negative reads from energy, big time, headline declines. Commodity prices have been a constant upward thrust on inflation. They're now going to become a deflationary thrust on inflation. And core CPI, PPI, PCE have all been decelerating in the last couple of months. Wage inflation year to date is up only 4.5%, clear deceleration. I think there's a lot of evidence inflation's rolling over.
As you talk, I think to myself, and I'm extrapolating out, so correct me if I'm wrong, does this mean that you're going long tech because you see the belief that perhaps the Fed will back off, and you're actually paring back on the commodity space if you're seeing a peak inflation type of environment?
Yes, I would, Lisa. That's kind of where I'm at. I think that then you look at the bond market, it's giving everyone a 50 basis point rate cut from 2 years to 30 years. The break-even rates have collapsed. The one-year break-even rate's fallen to 3 3/4% this morning, down from 6.5 just 3 months ago. It could be back to the 2% handle target of the Fed by the end of summer. So I think we get a rate pause, not a rate cut, but a rate pause by the Fed, maybe by the fall time. And if the market starts to pick that up, they're going to move away from commodity cyclicals. They're going to move away from defensive stocks. I think they're going to move more towards early cycle stocks, maybe consumer discretionary, and also, to your point, Lisa, I think technology and growth gets a leadership run again.
Hey, Jim, awesome to get your views, as always. Jim Paulson of Luthold Whedon, uncomfortable, seeking discomfort through most of this year, Tom.
Folks, that was such an important interview to go to Jim Paulson out in the Midwest. And, John, this is the divide. And to use the zip codes of Minneapolis, the 55402 versus the 10022 Wall Street financial divide, it's stunning right now. I mean, Jim just flat out says there, enough, slow down.
Providing any kind of outlook right now is tremendously difficult, but I'll allow Nomura to provide you with one. Here it is. Expect a recession to begin in Q4 22 with a risk of an earlier start. They expect an additional 75 basis point hike in July, 50 in September, 25 in November and December, and February 23. Then the cuts arrive. It's the rate cut call, Tom. 25 basis point cuts per meeting are likely starting September 23 to 0.875% by the end of 24. That is like way off.
John, I've never witnessed this. I don't understand the guesstimates of getting the incense bottle out and rubbing the sides, trying to figure out 2 cycles out.
I'm with you, Tom, but isn't that what the clients are asking right now? When do the cuts start?
Yeah, okay, that's what the clients...
When do the cuts start?
The answer is we don't know. The answer is maybe we don't know. John, I'm looking at log sterling here. What is the ramifications of a 117-pound sterling? It is an elegant chart, wicked south.
I can tell you it's driving Bremo nuts.
Well, I just think that there is a bigger point here, regardless of the parlor game of when the rate cuts begin, that people have been so conditioned that that's what will happen. They have not been conditioned by inflation that's going to become entrenched, and they don't buy that story. And that, to me, is the big takeaway from the idea of a rate cut call.
It was my number one takeaway from my interview with Mohammed on Friday. Mohammed Al-Arian turned around and said, how sticky will it be? That's the number one question you need to be asking guests. How sticky will inflation be? Beyond these prints of close to 9%, we've got to live with 4 or 5, and for how long 4? Futures down 0.5%. Steve Englander of Standard Chartered, the brilliant Steve Englander on this FX market, coming up shortly. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. OPEC's first oil market outlook for 2023 has been released, and it suggests no relief for squeezed consumers. The cartel expects global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year, but members already are falling far behind the volumes needed right now. The Conservative Party wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. London's Heathrow Airport is moving to limit the recent travel chaos. It's asking airlines to stop selling tickets for summer travel. The biggest airport in the UK will limit daily passenger traffic to 100,000 people through September the 11th. Heathrow is scrambling to hire more staff and says new recruits aren't up to speed yet. And American Airlines is sticking with its expectations for a jump in second quarter sales despite rising costs. In a filing, American said total revenue is expected to be up 12% in the period compared with the same quarter back in 2019. Meanwhile, costs for each seat flown a mile will also rise about 12%. And Peloton is taking one of the most dramatic steps yet to simplify operations and reduce costs. The company will quit building exercise bikes and treadmills at its own factories. Partners will now handle the manufacturing. Peloton is making the change after several months of turmoil. The company cut nearly 3,000 employees earlier this year and shares are down some 75% in 2022. Global News 24 hours a day, on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We've taken commodities down sharply. We've taken oil down 25 or 30 bucks, and discretionary has given us nothing, right? So this idea that some pause in crude or some weakness in crude would suddenly recatalyze the consumer, I think the market is suggestive of that not being the case here yet.
Chris Verone there of Strategas, a bad company. Futures down 0.5% on the S&P. And to Chris's point, here's crude. Lower again by 4.6%. We are down to 99.23 on WTI. Yields lower by 7 basis points. 292.25 on a 10-year, and euro dollar positive just about by 0.1%. Euro dollar 100.46 after basically hitting parity a little bit early this morning, Tom.
Doing what we're doing, which is to get the best voices we can on this time of shock on the data screen and maybe some potential crisis as well. He is absolutely definitive at what are called cross rates, which are the nuances away from euro dollar, dollar yen, dollar dynamics, the study of all the major currencies. Stephen Englander, iconic at Citigroup and now head of all of FX research for the important Standard Chartered Bank of the Pacific Rim. Which is the cross rate, Steve Englander, right now that gives you the most information?
Well, I think it's the, looking at the euro. I mean, it's just that it's so pivotal for everything and the market is so short. The other crosses I'm looking at, you look at what Asia is doing, particularly EM Asia, through this episode of dollar strength. It's really outperformed. And were it not for yen weakness, which is a story on its own, I think that EM Asia would be viewed as actually outperforming very well in this world. Doesn't mean that it's a buy right now because it's risk off and we're moving into recession, but it does mean that, on a relative basis, it's been far more stable than G10.
Do you assume that yen catches up with euro weakness, that we see yen go 136.78, dare I say a 140?
I think Japan's policy stance is puzzling. The BOJ Governor Kuroda said that they, discussed the need for more ease, which I think was a tough one to figure out. I think the ECB's silence on the euro in terms of its weakness. I don't think a weak euro is doing them any good right now. So, you know, I think that the Asian currency managers are more prudent in the way they manage their currencies and are not particularly looking for excess weakness right now.
Stephen, given all of that, you have a pretty bold call where you basically think that it's getting harder and harder to get the dollar stronger from here, and that what we've seen from the reaction on Friday, and John was talking about this yesterday, of actually dollar weakness on the heels of a stronger than expected non-farm payrolls report, highlights that people are overly long dollars, and that really sets a bar that is very high. So what does that mean in terms of how significant this could unwind, or whether people are really misreading the market right now?
Well, I think the key thing right now is whether gas supplies are restored in 10 days or so by Russia. If they are, I think euro shorts are in a bad position because a lot of this week's euro selling is on the back of concerns that literally the lamps are going to go out in Europe. If it turns, at this point, their gas kind of inventory seem to be normal. The question is, can they continue to accumulate? And that would sort of lead, actually dissipate some of the pessimism, I think. So it's a very important, it's one of the key things for the euro right now.
So do you foresee the idea of breaking below 95, the way that Jordan Rochester was saying, that we could see the euro go materially lower? Do you think that people are underestimating how much people are already positioned for that weakness at this point?
Oh, yeah. I mean, this is very different than, say, 2002 when the euro went below parity, when everybody had started off optimistic and long euros. And this was a real disappointment to the market. I mean, the market has been preparing for this for a couple of months, and I don't think the significance of parity is anywhere close to where it used to be.
Steve, I looked at log trade weighted dollar, and the steepness up to Plaza Accord was stunning compared to, yes, a more persistent strong dollar now, but nowhere near the movement that we saw in the early 1980s. Are we anywhere near where institutions come in to staunch the dollar?
I think we need some good news. I mean, you look at the news flow, China COVID issues, the Russian gas, ECB kind of ambiguous on what they're going to be doing. All of this is kind of risk off. So I think the dollar is supportive as long as that's the news flow. But I think if there's any signal that, there's some merit to optimism, I think we will see the dollar come off. I think the market is very long dollars right now.
Steve Englander of Stand Chart, great to catch up, taking things back 20 years to the early 2000s. Tom, early 2000s, do you remember that lineup of Citi in the early 2000s? Steve Englander, Bob Singe, Steve Saywell. What a lineup of foreign exchange that was 20 years ago.
Let's stop here, folks. And this is really important, and that John and I really, really look at the pedigree of the different shops. And people bounce around and move around as well. But they each have a certain character. Each one of these firms is different. We're trying each day to give you a cross-section around them. John, I would look at Folkers Landau and Deutsche Bank now as absolutely fascinating, the contributions they've made recently.
I go back to that team 20 years ago at Citi, Tom, because I think it produced about 5 heads of foreign exchange on Wall Street. 20 years later, over the next 10, 15 years.
Yeah, you follow the pedigrees. I think Bob Sinch is running a hockey camp now. I'm not sure of that, but it's north of Old Forge. Maybe Lisa can see her when she portages.
When Bramo flies off this weekend.
Yeah.
I'm not flying, I'm driving. Yeah. I'm worried about getting canceled.
The break,
these
folks,
airlines. I mean, seriously.
People on the break here, they're like, what do they do on the break? Well, yeah, I mix some more Tang, that's true. Lisa's completely focused on deer fly repellent. The 3M Ultrathon insect repellent looks to be the one, Lisa.
Is that serious stuff, Tom?
Yeah, it is. It's got like 47 chemicals in it.
If you're just tuning in, believe it or not, stuff's happening.
I was about to say, I'm watching the yield curve.
0.5% on the S&P, and some interesting stuff in the bond market too. 2s10s inverted. Where are we now, Lisa? 10, 11 basis points
it
negative?
Hit 11, it hit and it's the most going back to 2007, which I think is notable. We crossed the 11 basis points. We are now firmly through that. Negative 11 basis points.
Round it up, negative 12.
Yeah, looking at 12.
Round it up.
Stunning. Round it down. into CPI tomorrow, where we look for something close to 9%. Interest in the direction of travel here, Lisa, coming into that CPI print tomorrow. Retail sales later this week too. You, Mitch, I mean, I never thought we'd sit here and be talking about consumer inflation expectations of the University of Michigan Consumer Sentiment Report, but here we are because of Chairman Powell, I guess.
There is a consensus right now that is building that longer term we will revert back to a normal. The issue is how we get there. And now that seems to be the question that people are parsing through. But the consensus, at least for the moment, is for that longer duration bid.
Futures down 0.5% on the S&P from New York City this morning with Tom Keene and Lisa Abramowitz and Jonathan Ferro for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The week really getting started, and on the data front, it doesn't really start until tomorrow when we get CPI in the United States of America. Right now for markets, we are all go lower on the S&P 500. Futures down by 0.4%, breathing a little bit of life into the NASDAQ over the last hour or so, positive by 0.06%. Into the FX market, euro dollar unchanged, basically hitting parity earlier this morning, 100.39 on euro dollar. We spoke to Jordan Rochester of Nomura, who's looking at 97, maybe down to 95 on euro dollar through the summer, off the back of what may or may not happen with gas prices. And that's the problem, Tom. You've got to have a forecast on what happens with gas prices to have a forecast on what happens with Europe and ultimately with the currency.
I think the linkages are there. We had a pause here in the last 2 hours, John, but can you imagine, John, if we roll over and retest where we were at 5 a.m., 6 a.m. this morning?
On the euro, Tom.
On euro, on sterling. The sterling chart is shockingly elegant, John, as it goes away. I mean, John, are you a prime minister candidate?
I'm not, Tom. Would you like me to throw my hat into the ring?
No, everybody else has.
I'm not a member of the Conservative Party.
I get baffled.
If I was an MP of the Conservative Party, Tom, and I'm not sure many people would like that to happen, then sure, you and I could make a run for it. You'd be my chief advisor.
Let us pause, get Larry the cat. Let us pause here right now, folks, with an annual visit that we do with Anat Ambadi. She is at Stanford University with classrooms that are packed, railing about capitalism in a constructive way. It is her goal not to tear down our banks or our financial system. It is a goal to inform on their size. She's economics and finance professor at Stanford University and looks at this through an operations research perspective. It has been far too long. Wonderful to have you back. Thank you for joining. I want to go to what I think is unspoken, which is using JP Morgan as a proxy. Pre-pandemic, they had operating income of $45 billion, and after the struggles of the pandemic, they have operating income last 12 months of $53 billion. They're up 15% or whatever. They have sales per employee to die for, which is 460,000. Why are these banks that you often criticize constructively, why are they such profit-making juggernauts?
It's wonderful to be a big bank like JP Morgan Chase. It's a good life. It's a wonderful life. The pandemic worked fine for them. I talk to people in the sector. I look at how they did through and why, and you can see whatever you do for the economy, they end up benefiting too.
How do they attach themselves to the rest of America? James Dimon, Brian Moynihan, all the others will trot out all sorts of social programs, diversity programs, and the rest. If we have such success, if we have American banking being so profound, how do they extend that out to the rest of the country?
Well, I mean, they're just very privileged. I mean, if you say, how do they attach themselves? I mean, you know, we wanted to give PPP loans to small businesses. Well, the bank stood in the middle of that, got a little spread at no risk and fees, and it was a great windfall for them. Then the Fed bought corporate bonds and enabled a lot of issuance of bonds, and that was great profit for investment banks. So once again, you know, it worked out for them. You know, whatever bailout or support comes to anybody, they get a piece of it.
The arch question here, it came up the other day. Paul Krugman, I know, is led on this as well. I'm very, very big on this. Not monopoly, folks, but monopsony, which is a very different thing. You are one of the world leaders on this. It's like a rubber plantation in Singapore where the only place you have to sell your rubber is to one party. How monopsonistic is America now, and is that our capitalistic angst?
Very much so, and it's just a matter of power, of bargaining power, of power in the law. I mean, if you look at the way we now allow, you know, mandatory arbitration to be enforceable for consumers, for employees, you know, non-compete agreement, et cetera, there are all these subtle ways in which you know, corporations have power over people who work for them, whether they're defined as employee or gig worker, contract worker, or whatever. So it ends up that this power gets wielded.
Anat, you talked about the banks and how they always come out ahead. And we're talking at this moment, going from the macro to this micro moment, where people are talking about some possible disruption in markets that's significant given the tightening from the Fed, as well as some of the concerns about longer-term growth. Isn't it frankly, a support for markets and a testament to their strength that we haven't seen some sort of mass disruption akin to what we saw in 2008, given how quickly things are moving?
I'm not sure that we will see disruption from this slowdown in the economy. You know, ahead of all interest rate increases, there are ways the banks can increase mortgage rates, other lending rates that are sort of pegged, and so it's not clear that it's strong just because it doesn't implode in a given moment, because the system only starts really cracking seriously if there's a massive, you know, fear or run or somebody fails and all the dominoes start. Right now, we're seeing crypto action, which bears similarities to some of the issues we saw in banking, excessive borrowing, all kinds of defaults and chains of defaults, collaterals, et cetera.
But that's exactly the point, Anat, and I want to let you continue with that idea, but we always never expect the stress where it comes, right? It's never going to come in the same place. Where are you seeing the nodes of potential contagion, the nodes of stress that might not be in the traditional forms of finance that we saw in the past?
So my big fear that I've developed as I started thinking, you know, Jamie Dimon likes to say, or says that he told his daughter that a crisis is just something that happens, a financial crisis, every 3, 5, 7 years. So by then, we're really due for one, according to him. And my fear is cybersecurity. That is really what I think. You know, if you read Nicole Perlroth, you know, this is how they tell me the world ends, or even fictional things like, you know, 2034, you kind of know that there are things lurking potentially. And they hacked the New York Fed. They're hacking, and they're lurking. And then all of a sudden, you know, I don't know, should I print out my banking statement? Like, you know, who can take over? Now, I think banks might be more prepared than other industries, but if you look at the colonial pipeline and some of these disruptions of infrastructure, we can have a lot of contagion if it starts being, they hack hospitals, they hack municipalities. So if it's warfare, or from the digital dimensions, who knows?
And now we got to get back to the markets here with the way they're moving today. Right now, folks, a little green on the screen with NASDAQ, actually. Green. Have you ever been to the Hoover Institution? Do they let you in the door there? Have you ever darkened the door of the Hoover Institution?
Yeah, I talk to people, so I have
you
great
talk
friends
to them.
there.
Okay.
Yeah, I have great
I
friends
want to
there.
talk right now about the minority in this world, which is progressive economics, liberal economics, in a conservative America. What is the single legislative linkage progressive and liberal economics can have with a broader conservative America?
You know, my big battle that you've been familiar with, which I just sort of gave up because I got a little bit tired of spending all my time on it, is very bipartisan. You know, the idea that you'd be on your own able to absorb losses, that's bipartisan. Senator Sherrod Brown...
If the banks take a loss and clear the
Well, more equity funding. I mean, there was a proposal by David Vitter when he was there in the Senate with Sherrod Brown, and they had Senate, can you believe it, back in 2015, vote unanimously that they don't like too big to fail subsidies, except when it came time to discussing how to deal with too big to fail banks, they wouldn't vote for 15% equity, which is just for the top 6 banks, which is so radical. But no other company ever has less than that.
We've got to leave it there where the market's moving. Professor Admati, thank you so much for joining us with Stanford today. Too long a visit here. And John, it really harkens back to too big to fail, and some of these market indicators harken back to where we were 07, 08.
If we're thinking about crisis, what did Michael Schall of Market Field say yesterday? Lisa, don't look to where you typically look for a global FX crisis, maybe in emerging markets. What did he say? He said, look to Europe.
Yeah.
We're looking to Europe in a bigger way.
That could potentially drag things down, which really raises a question, at what point do things break? And Jordan Rochester was saying, we're getting there to that nonlinear place. Now, what is the trickle effect? And is it just basically the representation of the stress being diverted into FX that otherwise would be felt in spreads?
ING was talking to the team earlier this morning, and he basically just turned around, an economist at ING, a rate strategist, I believe. It's not about if or when there'll be a recession. It's about how deep it will be. in Europe. That's what we're all trying to figure out, how deep it will be. And with that in mind, this has really crept up on us. Next week is the ECB meeting. It's next Thursday. We're going to see something from this ECB that we haven't seen in 10 years, which is a rate hike, Tom. A rate hike, and then what? Another one, and
John, I'm sorry, the
this.
importance of it is tangible, where, you know, you and I should get on the Gulf Stream and get over to Frankfurt and cover this properly.
Are we going to fly through Heathrow, Tom?
Lando out. No, we're not going through
Getting
Heathrow.
there might be difficult at the moment.
But, you know, have Folkers Lando on and others to talk about this historic moment for Christine Lagarde.
We've talked a lot about the invasion of Ukraine over the last 6 months, and the next stage, at least of our coverage, and of course we'll cover that invasion of Ukraine and the war as it's ongoing, is the economic fallout. And that's just starting to come to the surface, Lisa, in a much more pronounced way.
And what is that economic fallout? I'm still sitting here trying to think about what the ramifications are for artificially curtailing the supply because of a lack of workers. Doesn't that lead to higher prices? Doesn't that lead to higher wages, at least in the short term?
At least to devaluation and higher prices. That's precisely
so then
correct.
How much does that trickle out into an economic proposition that is potentially problematic? And what do central banks do with that?
John, it's John Taylor 101, even in Adamati. It's the only thing she agrees with John Taylor on is, you know, it's simple. Depreciation, price up.
I can tell you she's smiling at the corner of my eye. Erin Brown of PIMCO
just busted her chops.
Is going to be joining us in the next hour on Bloomberg TV alongside Sarah Malika-Nuveen, the CIO, and Jean Bavin of BlackRock around the opening bell on why they're becoming less constructive on equities over at BlackRock. Futures are down by 1/3 from New York City. Good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and Mexico's President Andrés Manuel López Obrador will discuss ways to expand legal migration and improve security when they meet today at the White House. They'll announce joint actions to improve infrastructure and cooperation along the almost 2,000-mile border. López Obrador says increasing immigration would strengthen the U.S. labor force and help curb inflation. Billionaire real estate titan Sam Zell is urging the Federal Reserve to aggressively raise interest rates and break what he calls the inflation mentality. Zell spoke with Carlyle co-founder and Bloomberg TV host David Rubenstein.
I also think that interest rates could go up a couple hundred basis points and not throw us in a recession, because I think that there's been just so much capital splashing around that I think, you know, the first kind of major swallows of reducing that excess flow, I don't think are going to have quite the impact that the stock market is reflecting.
And you can watch all of that exclusive interview with real estate titan Sam Zell tonight at 9 p.m. New York time on Bloomberg Wealth with David Rubenstein. In Shanghai, there are fears the city is heading back into lockdown a little more than 5 weeks after exiting a 2-month ordeal. The city reported 59 new coronavirus cases on Monday. That is the 4th day in a row that case numbers have been above 50. The detection of a new substrain of the Omicron variant triggered 2 more rounds of mass testing in Shanghai. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
It's the combination of the withdrawal of liquidity and the increase of interest rates, which I think is starting to bother financial markets. My bet would be that at some point in the next few months, maybe even the next few weeks, we are heading for some kind of a financial accident.
Michael Scholl, Market Field Asset Management, really quite strong yesterday, I thought. Lisa, I thought it was really good how he pulled it back to focus on Europe.
Yeah, and that seems to be definitely the theme today with the parity watch hysteria that also is just bleeding into a general fear of European equities.
The general fear 2 hours ago was more general and more fearful than it is right now. There's a little bit of an improvement here. I could start at any item of data. Just to say red and green on the screen, NASDAQ even slightly green as well. With a chart, Kriti Gupta.
Well, Tom, we got to talk about that currency story, but in the perspective of the stock market, because of course we see that dollar strength. Well, it's weighing on the euro, it's weighing on the yen, really becoming a weakness around the world kind of story. But in the stock market, it shows up a little differently. In fact, if you're a foreign investor in the stock market, you're actually outperforming anyone who's holding it in dollars. And that's really what my chart of the day shows. It shows you the S&P 500 in blue. For our radio audience, stick with me. And the S&P 500 in dollar adjusted terms. And what you're going to see is that in the last year, if you adjust for the dollar, your portfolio you're holding on the S&P 500, well, it's flat, even counting that year-to-date loss that you've seen. If you're holding it, however, via the dollar, then you are actually seeing your losses eroded to the tune of about down 12% in the last year. So once again, it really speaks to that currency story, just how much of the dollar story is holding you back if you are a local investor in the stock market.
It speaks to the EM market weakness that we've seen, down 47% in the last 10 years as well. Right now, when B. Ritholtz stops by, of course, with an important podcast and writing, always thinking about these markets. And Barry, I want to dovetail your recession analysis and your upset at the media's hysteria over 2 quarters with the idea that 2 quarters with the idea of the earnings season upon us where we have a quarterly earnings frenzy. How do you dance the quarterly earnings ballet constructively?
Well, a couple of things. First, historically, the analyst community tends to overestimate earnings, except in the depths of recessions where they underestimate them. They miss the turnaround. But that said, we've been at record earnings for 2 years. You know, the pandemic was very, very good for earnings. Give the American people $5 trillion in stimulus, and they'll go out and spend it, and it works its way to the bottom line.
American Airlines 2 hours ago out with 12% revenue growth, blah, blah, blah. Obviously, 12%? Inflation kicked.
That's giant.
Inflation kicked. How do you adjust for this new inflation we have to figure out which company is going to deliver persistent free cash flow?
So here's the crazy thing about inflation and stocks. You know, inflation isn't selective. It cuts across the board. It hits everything. And so there's lots and lots of evidence that not only are companies passing along price increases given constrained supplies to the consumer, but the consumers have more or less been willingly paying it. And that seems to not have a negative impact on revenue and not have a negative impact on profits. If companies can pass this along, it shouldn't have too big an impact on the bottom line. And that's why, surprising to a lot of people, stocks tend to be a pretty decent hedge on inflation.
So Barry, given that, do you think that this is a time to be more aggressive than people are currently at least expressing in their bearishness?
So here's the question. Whether or not we get a recession in 2023, I don't even want to talk about 2024. It's hard to see the current environment as being recessionary given job increases, wage increases, consumer spending increases. How much of additional tightening is already reflected in the market dropping about 20% year to date? And how much further is the Fed going to go in order to tamp down inflation? Remember, the CPI report that we're going to get tomorrow is backward-looking. Lots of evidence suggests that we're already substantially past peak inflation. I don't know if it's in the June CPI report we get tomorrow or the July CPI report we'll get in August, but I don't think the Fed should be looking at 75 basis points unless they want to cause a recession. They should be looking at 50, which means that we're probably 2/3 through this sell-off. And if you want to start legging into equities here with the understanding that this may not be the bottom, there may be more to go, do it in chunks. That's how you get aggressive. You start buying here on the expectation, hey, maybe we end up down 25 or 30%, but the economy is too strong to see an appreciably worse market from there.
Given the strength that you hear about and that you're talking about, how much can you still count on bonds as a buffer at a time when duration seems to be the consensus bet?
That's a really fascinating question. Look, we're coming off a 40-year bond bull market where bonds did nothing but go up and rates did nothing but go down. Now the question is, how high are bond yields going to go before they start to becoming more attractive to investors? So if we of volatility and a lot of uncertainty. I hate that word, but we don't know if the Fed is going to have a policy mistake or if they're going to engineer a soft landing, and that's the answer to your bond question.
We got to get back to the markets. One more question, Barry Ritholtz. The idea the corporation should buy back shares when things are lousy. Are we here?
So the problem is that too many corporations, you know, they're price chasers and they're buyers when things are good. It's rare in the depths of an 08-09, right, that we see that. You know, if you want to engage in increasing shareholder yield and you want to raise your dividend and buy back stocks, down 20, 25%, certainly a good place to start, assuming your cash flow supports it. Absolutely.
Barry Ritholtz, thank you so much. Lisa, we've got to summarize where we are right now. I would summarize it as more constructive than it was 2 hours ago.
And that seems to be a theme, at least in these early hours, that overnight things get disruptive. And I wonder how much that ends up being a liquidity story at a time when we just had the lowest volume of treasuries trade going back to December. How much is that kind of what's whipsawing markets overnight that then calibrate and stabilize when people finally come to the office price in New York.
I think of everything on the screen, what we've covered it today, but oil is just, it's amazing that drop we saw in oil 2 hours ago.
Especially considering the OPEC report. I mean, OPEC put out its first report of the year talking about the outlook for the year ahead, saying that supplies are not going to meet demand, even with the expectation for demand to cool off a little bit in the face of some of these things. And oil is still down. I mean, how much is this a China story? How much is this basically just a positioning on the futures, not the physical market trading? I don't know.
Lisa, we mentioned the 3M deer fly repellent earlier. We set off a firestorm of analysis on Twitter as well. A firestorm, I say.
I'm looking forward to the welts. I'm hoping to avoid them. You know, that definitely is welcome. As we talk about vacation plans, though, we can't lose sight of the fact that a lot of people are not leaving to go on vacation because these markets are so tumultuous.
Oh, that was a very nice segue there.
Thanks, I tried.
Some of the deer
Let's get back to the markets, not deer flies.
North of Old Forge, they've got wingspans like the B-52s at Camp Drum.
Think about this. Really, why do you keep going back to it? They're really the bane of my
existence. I could see you out there with one of those hats with a mesh around.
Oh, I love those.
Red and green on the screen. NASDAQ positive. I'm optimistic. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Live from New York City this morning. Good morning, good morning. Your equity market recovering just a little bit, negative 1/3 on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, U.S. dollar dominance.
Dollar is strengthening.
There's a lot going on for the dollar. You have a host of global issues, clearly, the energy crisis.
There's massive divergence in monetary policy between the ECB and the Fed.
US is heading into recession. Europe's probably already there.
The dollar is the so-called risk parity antipole.
Where do you find safety? You find safety in the dollar.
Driving the dollar at the moment is safe haven flows.
There's not really a big trigger that you can see which can turn around euro or the dollar at this point.
Number one, a shift from the Fed, and number two, a change in the energy dynamics. And that just isn't happening.
A very strong dollar.
It's going to add another weight to the U.S. corporate earnings season.
That will also begin to limit U.S. growth.
Clearly a lot going for the dollar at this point.
So much going on right now. Let's get to the team. PIMCO's Erin Brown, Nuveen Sarah Malik. And Sarah, I'll start with you. Has the equity market factored in what is developing in foreign exchange?
I think that it's going to be another challenge during our earnings season. Earnings season could actually be the next shoe to drop. We're worried about what the demand destruction effects are going to be. We've seen earnings actually consensus going up year to date, and we're wondering whether that's going to be factored in for the second half of this year, where earnings actually take a hit, and we see some pretty poor outlooks out of companies. That is our concern, and that's why I think the markets have been pretty volatile leading into the kickoff of that season.
Erin Brown, you're on the same page. I know we've priced in higher rates to some extent. We have not started to price in lower earnings. Your thoughts?
No, keep in mind that with respect to the dollar, about 30% of S&P revenues come from overseas, and the dollar has now strengthened about 10%. So on a very simple math basis, that's about a 3% hit to earnings, which I don't think has been fully incorporated by earnings estimates. But that's just one part of the problem. The market is also still pricing in pretty strong margins for this quarter as well as through year end. And while the earnings bar for this quarter isn't that terrible, it's about 5% year over year. When you come into the second half of the year, the market's still pricing up earnings about 10%, which is going to be a very, very difficult bar to be able to beat. So I still think that earnings need to come down.
Erin, if you're a Fed official looking at this dollar strength right now, is it our currency your problem? Is that the message to the rest of the world?
I think that's right. I mean, if you think about what's really driving the divergence between the dollar and the other developed market currencies, the first catalyst was certainly the central bank divergence. But now you've seen, I think, much more strongly being impacted is the fact that Germany is now now lobbing in a trade deficit, and I think that that's really what's driving this significant departure between the dollar and the rest of the developed market currencies. Just given the oil price impact and the gas impact that's hitting the shores of Europe, even more significantly than in the U.S.
Euro dollar bouncing off parity this morning, 100.53. It's not just euro dollar, dollar yen over the last few weeks, getting everybody's attention. For some people, we're looking for a move maybe to 140. Secretary Yellen spoke a little bit earlier on. This is what she had to say. In general, our view is that countries like Japan, the United States, the G7 countries should have market-determined exchange rates. Mike McKee joins us now for more. Mike, that doesn't sound like a Treasury Secretary looking to intervene anytime soon.
No, she's not. And the U.S. has pretty much given up on that as a tool. It might be a signaling device, but they haven't decided that they need to send a signal yet. As you were saying, it is our dollar, their problem. And the problem that the world has is that after 1990s, major Forex interventions went away because they didn't really work. They might move currencies for a day or so, but then they snap back. And the reason is there's so much traded in foreign exchange daily that there isn't enough money for most countries to continue fighting the market. The U.S. has now a larger pot in its exchange stabilization fund, which the Treasury would use, but $222 billion versus $6.6 trillion isn't going to do a whole lot. The G7, as Janet Yellen said, wants markets to set rates, although it does track volatility. Keep an eye on that. If that gets to be a problem, then you have an issue. And here you can see the other issue. And Janet Yellen is going to be well aware of this from her time as the Fed chair. Back in 1989, the dollar was soaring against the yen, and the Fed was trying to raise interest rates at the same time. The Treasury was selling dollars to try to push it down, so working against the Treasury Department and the Fed. So the Fed is hoping that the Treasury doesn't intervene because it wants to bring down the value of the dollar, but it wants to raise interest rates more. And here's something else that's unusual. Take a look at this. You mentioned oil just a second ago and the effects it's having. Normally, the oil and the dollar trade in an inverse relationship, but look what's happened at the tail end there on the right-hand side. Right now, it doesn't matter how strong the dollar is. The oil price is remaining high, and those are external factors that intervening in the market probably isn't going to help.
Mike McKee, I wanted to get your thoughts on this. Mohamed El-Erian has talked about these little fires everywhere that we're trying to put out. Heathrow Airport coming out and putting a cap on passenger traffic through the airport through September 11th. Just the economist in you, Mike. I just wanted to understand how you responded to that when you saw that news earlier this morning.
Well, it's clearly going to have an effect on the air travel industry and the ripple effects on the industries that depend on it. Heathrow being one airport, it is a major exchange airport or transfer point. It isn't going to have a huge impact on the global economy by itself, but it will hurt Great Britain. And it may be a sign of more things to come as more and more people travel, and we haven't been able to fill the jobs that keep those people moving through those airports.
Mike McKee, thank you, buddy. As always, we'll catch up with you tomorrow. Mike McKee will lead us through the CPI report tomorrow, then much more economic data still to come later in the week. We mentioned Mohamed. He was weighing in on this a little bit earlier. He said, albeit an extreme case, this is a useful illustration of how persistent supply dislocations can lower demand, yet keep inflation high. Sarah Malik, I want your thoughts on this. Is it too early to bet against inflation?
We're going to find out tomorrow with CPI, and we're going to be watching for three things there, and that's wages, shelter, and any shift in spending from goods to services. But even if we get some good news in moderate inflation, there's still bad news out there. Number one is it too late because the Fed is on such an aggressive tightening path that they've actually already maybe caused a recession or we're about to hit one. The second is the earnings that we talked about. The companies, we're going to get a kickoff with financials tomorrow. There's going to be, on the upside, we're looking for strong trading, but on the downside, weak capital markets. It's going to be the companies with pricing power who can overcome inflation, but not all companies are going to have that. So I think it is too early right now with the headwind of inflation and also the headwind of earnings and the fears of a recession and markets only at average valuations and earnings at risk. I think it's too early right now to go headlong into equities and say this is the bottom.
Sarah, you mentioned the banks. I know you like two of them, Fifth Third and Morgan Stanley. Why those two?
Well, in the big bank, we like the regionals over the larger banks because companies, like Morgan Stanley, are going to have these capital markets issues and investment banking issues, which are down significantly. Also, we have a credit cycle overhang with a recession potentially coming our way. So something like Fifth Third is our preference of the two, while Morgan Stanley is our big bank favorite. We like Fifth Third because of its footprint, Southeast and Midwest. They pay higher wages, so they have inflationary protection in place, strong growth with momentum banking, and nice cost control. So they're well positioned, and they don't have that capitals market business while they do have leverage to higher interest rates. But in the bigger banks, with Morgan Stanley, they have that crown jewel, which is their wealth management business, to help offset that capital markets volatility.
Sarah, what's been your understanding, and how has your understanding developed of the relationship between rates and the equity market and certain segments of it? Utilities maybe not behaving in the way you might expect with rates shooting higher the way they have, and banks for other reasons, banks not trading in line with rates either.
I think the issue is because people are worried that the rate hikes are going to be so aggressive that it really crimps global growth, and that's a negative for the equity markets. Also, it makes other asset classes and cash equivalents look more attractive than equities. We've seen that even this year between equities and fixed income, where the traditional 60-40 equity fixed income portfolio has not been working. It's not a source of diversification. We've actually been looking at some alternative asset classes to try to help portfolios which are really not being resilient, and diversification has been much more challenging this year, and that's likely to continue at least for the short term.
Speak to that, Erin. Where'd you get that resiliency in a portfolio in a world of sell everything except maybe energy so far this year?
Well, I think that's right. I think you do need to keep those inflation hedges on in your portfolio, but you're also looking across your portfolio both at equities, credit, as well as broader fixed income, and looking for assets that you think can perform well in risk-off environments and more recessionary environments. And I think there are pockets of the equity market that will do well. Healthcare is a sector that we've talked about, but is something that's underperformed, certainly over the last year or so, and still offers good value to investors and should, be resilient in a downturn. I also think that there are, good credits in IG that are starting to look really attractive, just given how much spread widening you've seen year to date. But I would really stick to those, that are money good, that have free cash flow generation, and that you think can withstand a hit to nominal GDP. And it can still do well and outperform. So there are pockets of opportunity. You just have to dig a lot deeper than just buying pure beta in the market.
Erin, you said keep those bets on inflation on. Can you help me understand whether you can have a bet on both inflation and decelerating economic growth?
Absolutely. I mean, firstly, going into recessions, typically in recessionary environments, inflation tends to be the last shoe to drop. And so inflation tends to have long legs in late cycle environments. That said, we're also in a really unique environment right now where it's not demand that's driving inflation, but it's really supply constraints. And so I think that you look for those pockets that are supply constrained, whether it be agricultural commodities or hard commodities like oil that you think still offer value, maybe not in the spot rates, but if you look out, and think that this is going to be a more protracted inflationary cycle, there is real opportunity still to take advantage of, market pricing. And I do think that inflation can continue to do well in this environment, maybe not broad-based, but certainly in certain pockets where there's supply constraints.
We'll talk about those energy names in just a moment. Erin Brown, Sarah Malik sticking with us. Equity futures this morning on the S&P 500 were much negative than where we are right now. We're down 0.2%. I know a ton of you on Euro Dollar Watch came pretty much close to parity to call it parity. Euro Dollar 100.57 right now. Let's get you some stocks on the move ahead of the opening bell. Here's Abby.
John, well, a couple of the stocks dragging on futures right now, perhaps creating a third down day in a row. Let's see how we end up many hours from now. But ExxonMobil, oil, of course, back below $100 per barrel. That's dragging on ExxonMobil down 2.5%, along with some of the other big oil names. Blockchain, Riot Blockchain, down 1.2%. This, of course, is Bitcoin is back below $20,000 per Bitcoin, hanging on to support quite tenuously. It's going to be interesting to see how that plays out. To the upside, though, and this could be a piece of why we are off those lows that you were talking about. American Airlines up 1.5%. They pre-announced to the upside. They saw preliminary revenue for the second quarter, 12% above the year a year ago, and also they kept their outlook in place despite rising costs. Similar deal for PepsiCo, very strong quarter there. They actually boost the outlook as demand remains resilient. The previous quarter, strong. They beat both top and bottom line, and they're saying that consumer demand trends show strength and resilience. It's interesting, John, this, of course, is 10% of the S&P 500 consumer staple index. Let's watch to see outperformance in that index today, perhaps.
Abby, thank you. PepsiCo with earnings, looking for more earnings through this week. This from Bank of America just moments ago. Lots of reasons to be concerned. We expect inline EPS to the second quarter with a flurry of downward revisions. They go on to say tech has been viewed as the new defensive sector, but we believe tech earnings will not be as defensive as many hope. More on the outlook for earnings in just a moment. Coming up on this program, the US looking to ramp up the pressure on OPEC.
We will have the opportunity among this very broad agenda to talk about energy security with the leaders of the OPEC nations in the Middle East. There is a capacity for further steps that could be taken.
President Biden heading to the Middle East to make his case. That conversation up next.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The world has never witnessed such a major energy crisis in terms of its depth and its complexity. We might not have seen the worst of it yet. This is affecting the entire world.
Global energy supply challenges topping the agenda as President Biden heads to Israel.
We will have the opportunity among this very broad agenda to talk about energy security with the leaders of the OPEC nations in the Middle East. We do believe there is a capacity for further steps that could be taken. We will sustain intensive engagement in our effort to ensure that at the end of the day, we're having a positive impact on the price of oil and thereby a positive impact on the price of gas.
Let's get to the Bloomberg team for more. Julian Lee from London, Emily Wilkins down in DC. Emily, good morning.
Good morning, John. Well, certainly President Biden knows that gas prices are a big issue at home, and they will be a big issue internationally when he travels to the Middle East and meets with Saudi Arabia and other oil producers in the region. Now, President Biden has said that his goal is to help bring stability to the region, obviously hoping that that will perhaps lead to more oil production, perhaps a lowering of oil prices. But, John, as they noted, this is a complex issue. It's got many factors, and there are many skeptics, even some within Biden's own party, about exactly how much this trip is going to do and how much it will really ultimately even lead to a lowering of gas prices here. It kind of shows the bind that Biden's in. He's trying to figure out some way to lower prices. He's done a number of things, but so far, most Americans still feel a lot of pain when they head to the pump to fill up their cars.
Looking forward to the coverage, Emily, from you through the week and from AMH. I can tell you Anne-Marie on the ground. We'll get coverage from her from the Middle East through the week. Want to come to you, Julian, on this OPEC report, looking ahead to not the back end of this year, trying to look ahead to 2023.
Yeah, they are, and it's a sobering report, as the one last month from the International Energy Agency that pushed their forecast out to the end of 2023 was also sobering. I mean, OPEC sees demand growing more quickly than supply outside its member countries. They see demand up by 2.7 million barrels a day next year globally. An additional 1.7 million barrels a day of non-OPEC supply. That means the OPEC producers are going to need to pump another million barrels a day just to stand still in terms of meeting demand. That doesn't leave them an awful lot of room to pump the additional oil that President Biden and others are hoping for to help bring down prices.
Julian Lee on the latest. Emily Wilkins from DC, Julian from London. What a difficult spot for energy. The question I've been asked a lot to ask my guests is basically, do you buy what has won recently, or do you buy what has been winning all year? Energy, part of that all-year story. Is it the former or the latter? Erin Brown, Sarah Malik, back with us. Sarah, which one is it? Keep buying what's won recently, or buy what's been winning all year? And energy is a big part of that.
think you need to look at the reasons behind both. So energy was our top pick coming into 2022, and we still like it. There's noise around the sector with China lockdowns and that impact on demand for the short term. But if you look at the long-term, focus on three things that'll impact the sector: supply, demand, and what are the producers doing. Supply will remain tight. Demand is not even at pre-pandemic levels at this point. And the key to the story is the producers are being very conservative. They're returning cash to shareholders and focusing on dividends, and that's going to keep the cycle tight. Now you can look at the other side and say, what hasn't worked this year? That's growth stocks. We actually like select technology stocks. These companies tend to do well in periods of slowing economic growth, which is what we're in right now. So you can look at quality tech, not unprofitable tech, not speculative technology companies, but high quality companies like Salesforce, Microsoft. These are companies that should be very resilient in the coming cycle.
Sarah, just on tech, I mentioned that note from Bank of America moments ago. They said tech has been viewed as a new defensive sector. We believe tech earnings will not be as defensive as many hope. Do you share that concern as you look around for the places you want to be in tech, the places you don't want to be?
I think broadly, we share the concern that you need to be very selective in technology. Which companies have pricing power, have tailwinds? You need to stay out of areas that have been very competitive. Companies dependent on advertising. You've even seen it with the post-pandemic plays like Netflix, which have really struggled as people have turned away from doing things at home and going out and experiencing entertainment. So I don't think it's going to be as easy as it was in the past, like during the pandemic when technologies just worked well. But there's companies that are really strong in digital and with strong cloud computing businesses. Those should continue to do well.
Erin, I hate to reduce the market down to just energy versus technology, but can we do that now, Erin? Your thoughts on the two industry groups, the thoughts on the two sectors?
I mean, I think if you just have to break it down like that, I think energy will continue to outperform. I mean, keep in mind that even if you look at forward pricing in the energy curve, the market is really still pricing this to be a fairly short-lived event of market dislocation in energy prices, and we think that there's longer tails to it, just given the supply and demand dynamic that is going to persist through next year. So energy should continue to do well, we think, in this environment. I think cash-rich, high free cash flow generating tech companies that are more geared towards services as opposed to the consumer, I think will do well. But broadly speaking, tech as an sort of an aggregate sector, I think is still going to continue to hurt in an environment where duration, is not rallying.
Erin, one question I've asked over the last month repeatedly on the energy story, and I'm trying to work this out, I know others are too, is the cause of the recession going to become the victim of it? And that's the energy sector for a lot of people. Erin, why won't that be the case?
Well, I think if you keep in mind that this is not a demand story right now that's driving energy. It's really a supply story and limited supplies that's really constraining the environment that we're in. Eventually, I do think you'll see demand destruction, and certainly you've started to see that on the margin. In Europe, you've started to see some chemical companies, some pharmaceutical companies have to constrain output, and that's starting to also, just given the high prices, constrain demand. But I think that there's going to be longer tails to that, just given the very acute supply-constrained environment that we're in.
Erin Brown, Sarah Malik, to the both of you, fantastic, as always, as we work through some big issues going into CPI tomorrow, then later this week to earnings. One note I wanted to bring to you from the last 12 hours, JP Morgan's Marko Kolanovic, still max bullish, just maybe a little less so, hedging some of that bullish view. He said, we reduced the weight of corporate bonds and increased the weight of government bonds in our model portfolio. Our model portfolio's pro-risk stance refocuses on equities and commodities with a credit underweight, serving as a partial hedge in an adverse scenario. If you read through the note, though, he is still singing a super, super bullish tune about a second-half recovery led by China and an equity market bounce back as well. That's the latest from Marko over at JP Morgan in the investment bank. Coming up, the morning calls, and later, BlackRock's Jean Bavin expecting overly optimistic earnings estimates to persist. That conversation around the opening bound. That's next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City this morning. Good morning. Equities down about 0.1% on the S&P 500. Let's get to your morning call. Citigroup upgrading JP Morgan to buy, seeing an attractive risk reward with higher capital levels now priced in. Next up, Wells Fargo downgrading the gap to equal weight, pointing to a number of company-specific challenges on top of growing macro headwinds. And finally, Morgan Stanley downgrading American Express to equal weight, expecting weaker consumer spending with inflation eating into shoppers' disposable income. Their stock is down by about 3%. Coming up, futures bouncing off session lows. BlackRock's Jean Bavard is not optimistic about the rest of this year for risk assets. The man from BlackRock joins us next. Your opening bout just around the corner from New York. With futures down 0.1%. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Be
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Live from New York City this morning. Good morning to you all. About 20 seconds away, equity futures look like this. We're negative about 1/10% on the S&P 500, recovering this morning. On the Nasdaq 100, positive 0.5% on the Nasdaq. On a Russell of small caps, down about 1/3%. That's the opening bout. Switch up the board and get to the FX market. Euro dollar, the epicenter of everybody's focus, seemingly earlier this morning. Unchanged on the day, 10041. Jordan Rochester of Nomura saying this one could go down to 95 later this summer in August. That's one to watch for sure. Yesterday, yields lower. This morning, yields lower again by 7 basis points, 292.07 on a 10-year going into CPI tomorrow. Crude pulling back 99.10 on WTI, down by almost 5 percentage points. And something that doesn't get talked about enough, included on this program, is China. The infection rate is climbing again. Most people suspecting in China's future is more COVID restrictions, and ultimately, what does that mean for the commodity market? Marko Kolanovic of JP Morgan, we mentioned him earlier this morning. He's looking for a rebound in growth in the second half of this year, led by demand. Where? In China. What did Goldman do a little bit earlier today? Goldman had to downgrade their price target on copper to 6,700. They were out in the 8,000 something on copper. That's a big change. Let's get you some movers at the opening bell about a minute in. Here's Abby.
John, that is a big change for copper, but relative to Amazon today, as the Prime Day starts, the first day of 2 Prime Days, Amazon, little change, slightly to the upside, but it is a heavy weight. And actually, it's come well off of its pre-market low, so now up about 0.7%. Investors cheering it to some degree. Investors also cheering PepsiCo up about the same amount. This, of course, after they put up a very solid quarter. Importantly, raised the outlook for a second time this year, saying that the consumer remains resilient, at least for those soda and chip products. So the staple sector, pretty solid. Peloton really up quite nicely, up 3.5%. They're sending out the manufacturing of their bikes, so investors, traders encouraged that perhaps that will improve the margins. You were mentioning that downgrade over at Wells Fargo on Gap, John, down about 7%. Well, one of the headwinds includes, as you know, CEO Sonia Singhal stepping down, and also lots of other issues there as they bring numbers down. Gap not able to get out of its own way, John.
Abby, you were looking for that move in discretionary off the back of the move lower in crude. There we go, at 1% on consumer discretionary. Energy down by about 2.23% around the opening bout. We are positive 0.1% on the S&P 500. Big few weeks of earnings coming up. Dan Ives of Wedbush saying this: the street is already baking in a mild recession. Overall, we like the setup to own the beaten down tech sector into second quarter earnings season. The latest from the bull on big tech, Dan Ives. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, beaten down sounds like almost a delicate way to put it, considering the NASDAQ 100 wiped $5.6 trillion worth of its value out in the first half of the year. And even if we are off the lows of the year so far, the index is still down about 27%. And for that narrower New York FANG index group of stocks, they're down 32%, of course, pressured by higher rates, which damages high multiple stocks more so given the value placed on future earnings. And pretty much all of the stocks in that NYSE FANG Plus index are down since they last reported quarterly results. The move smaller for the likes of Microsoft and Alphabet, but check out Amazon and Tesla, each down more than 20% since they last reported. And the next round of reports could catalyze even bigger moves. Bloomberg data shows that traders are bracing for price swings of anywhere between 4 and 13% for the FANG cohort, in part due to the fact that earnings estimates cuts just really have been lagging. So it leaves more room for big surprises and potentially more dramatic price action, because the street is still expecting tech earnings to be up about 13% this year. That consensus has not changed much over the recent months, even as the picture economic-wise has deteriorated. So even though we've seen valuations coming in, the NASDAQ 100 now trading at a forward PE ratio of about 21 rather than north of 30 we saw during the pandemic, that means that if you start to see something shifting in the E, if earnings estimates move lower, these stocks could still end up looking quite expensive, John.
Kelly Lyons, thank you. Brilliant work as always. Another downgrade in the last 12 hours. This time it is from Evercore and Julian Emanuel to 4,200, down from 43. Says this: a slowdown is unfolding, combined with a stronger dollar, labor market strain, Supply chain issues, inventory builds, margins, EPS are under pressure as prospective recession scenarios develop. With the latest, here's Taylor Riggs.
And John, interesting, we spoke with Tracy McMillan of Wells Fargo yesterday, looking at earnings of $200, and the low right now on the street is about a 205. So you're really starting to see some of the revisions come in. I think this chart shows it all. I think the everlasting theme this year has been the optimism by the street, if you will, on some of the earnings guidance. But now actually on both sides of the pond, you're starting to see some of those revisions cuts finally start to come in. I think if you go to the next board, what you'll see is that sort of the year-over-year growth numbers, they've come down from the highs of maybe 5, 6, 7. You're now looking at just the earnings per share growth on a year-over-year basis of about 4%. But I think it's important to point out that that number is still positive. When we talk about an economic recession, does that mean an earnings recession? It doesn't. Right now, there's actually still growth on a year-over-year basis. Take a look at this terminal chart. Kaylee was talking a lot about this, right? Sort of the forward PE guidance and how we're thinking about valuations. Yes, it does come like it's come down. Growth is still a little bit more elevated than value at the bottom of your screen. Overall, though, for the average, you're looking at about 16, 17 times. But those numbers have come down quite a lot, John.
Taylor Riggs, thank you. Looking forward to the close a little bit later with Romain Bostic and Caroline Hyde. Taylor leading the coverage there on the earnings you can expect and what it means for this equity market too. We've had some big calls in the last few days. This from Nomura caught my eye. Expect a recession to begin in Q4 22, the risk of an earlier start. They say we expect an additional 75 basis point hike in July, 50 in September, 25 in November and December and February 23. And then here's the call. We're already forecasting cuts on the street. This from Nomura, 25 basis point cuts per meeting, likely starting September 23, taking the rate down to 0.875% by the end of 24. I'll say this up front before what I'm about to say. Nomura's been great on the Fed so far this year. They were calling for big hikes when other people weren't. But I'd love to borrow their crystal ball for 2023 because I can't get beyond August right now. BlackRock says the world has changed. They say the world has changed a lot. They write the following: we're braving a new world of heightened macro volatility and higher risk premia for both bonds and equities. The regime is not necessarily one for buying the dip. They go on to say policy will not quickly step in to stem sharp asset price declines. BlackRock's Jean Bavin joins us right now. Jean, it's great to catch up with you. The great moderation is over. Talk to me about what's replaced it.
Back to a more volatile future. The title of our mid-year outlook is what we are in, I think. And I think, just to make the core point here is a lot of the logic I think we are trying to tend to gravitate to is applying the old business cycle playbook, the things that have worked for the last 40 years, which we don't think they'll be working going forward. So the great moderation is over. To our mind, that means that this last 40 years where we were able to see both growth and inflation volatility basically being very subdued has changed. It's already the case for the last 2 years. And we think this is persistent because the reason behind it is we're in a world that is really shaped by production constraint. This is the pandemic restart, but it's more than that. It's also the climate transition that's going to continue to increase costs. It's also the fragmentation of the world. And that world is one that is not easy to navigate. It's going to be worse trade-off for central banks. They won't be able to stabilize it. And that's the world we live in now. So there's no Goldilocks, there's no soft landing in that world. And I think that's the main call we're making here is don't hope for that. It's going to be maybe a stable growth environment, but then we'll have more inflation or vice versa, but there's nothing really in the middle.
Jean, talk to me about then the kind of inflation number that you think we have to get used to, get comfortable with.
Well, central banks are talking as if they're going to try to bring inflation back to 2%, their target. Doing that quickly on the time frame that they're expecting it will have to imply a very dire economic cost. So that's why we're worried about recession, and markets are at this stage. So in the end, we don't think they'll deliver that 2%. We'll end up living with more inflation. We're thinking maybe something more like 3%. Which for the central bank world is not something. It's a lot above their target, so they will see that as a major miss of their objectives. But in the world we're living in, it's not so bad like a cost to live through given the alternative. So that's the kind of numbers we have in mind, like 3 more than 2 for the foreseeable future.
Jean, I was looking at your return assumptions, just short term versus longer term. short term, you're not constructive risk at all. I know that. That's front and center in the mid-year outlook. Longer term, you are very constructive on equities. Can you tell me about your longer term return assumptions and whether that's accompanied with a higher level of volatility compared to what we'd seen in the last 10 years? Should I be expecting lower returns, higher vol? Is that going to be the change I need to get used to too?
So I think when you look over the next couple of years, the big bifurcation will be about whether we are right that we're going to live with more inflation, that's our call, or else is going to be one where we're going to see maybe inflation closer to 2, but a lot more volatility in growth. Under our baseline, which is living with more inflation, we think we're going to go through a burst of growth volatility, but that's going to taper off, and that's going to end up being positive for equity. So that's why we are constructive, as you say, on a more strategic basis. We think we have historical equity returns that can be delivered in this kind of environment. But we're tapering that off a bit because we think this is still going to be, we're not back to the Great Moderation. So I think we need to expect higher compensation for taking risk. And so historical to lower our return assumption on a 5-year basis if indeed we end up living with somewhat more inflation. If we come to the conclusion that central banks are really going to try to break the neck of inflation back to 2 and aggressively, which is the rhetoric they're telling right now, we don't think they're going to stick to that, but that's what they're telling us right now. In that world, then we would be starting to feel more negative even on a more strategic, longer-term expectation.
Jean, that's risk, that's equities. Where do bonds fit in? I've spoken to a lot of people. I've got a long, long list of people now who think that we've seen the peak on a 10-year Treasury yield. They're pretty confident of that. They're saying you should bet against inflation. I see that in break-even, Sean. That's what the market's been doing over the last several months. You take the other side of this, Sean. Walk me through how bonds and inflation protection fits into your view going forward from here.
Yeah, I think the main thing, again, and I'm going to go back to this because that's the core here, I think what is the most underappreciated feature of this new environment is that there's a much worse trade-off between growth and inflation. So you cannot have it both ways anymore. And so as a result, the inflation is not going to come back down very quickly. These supply constraints, these production constraints, even just from the pandemic, haven't even started to really unwind. So I think we're talking about many months of inflation persistence, and there are structural factors behind that. I have a hard time saying how you can get 10-year at these levels if we're living in a world where inflation is going to be closer to 3. Break-even, a 5-year break-evens now 2.1 doesn't make any sense for us. This is 2.1% 5 years out, up to 10. We're going to be more in 2.5, 3%. So strong conviction there that this inflation is a bit too optimistic expectation from markets. And again, that's because the trade-off is much more acute than we've seen over the last 40 years.
John, we'll keep talking about this. We'll bring it home to the consumer as well in just a moment. Jean Bavin of BlackRock sticking with us. Equities right now at 0.4% on the S&P. This is a bounce back from earlier this morning. On the NASDAQ, we're up about 8 or 0.9%. Coming up, the health of the US consumer in focus with investors bracing for corporate earnings.
People are worried. Can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer?
That conversation up next.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
People are worried. Can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer? And that growth is going to be really what drives confidence in equities and really what dictates the direction for the rest of the year.
We've got a little bit of everything this week. You've got economic data, CPI in America, then on to UMich and retail sales later on this week too. In the middle, you'll get an earnings sandwich from the big banks as well. We've had PepsiCo a little bit earlier this morning. Here's a line from them. Our updated full-year guidance reflects the strength and resilience of our categories and consumer demand trends. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, a resilient consumer leading to the second growth-raising forecast for revenue for Pepsi. They now say revenue is going to grow 10%. That's up from the prior 8% forecast, which already was up from the 6% forecast for annual growth that they had given originally. It's worth noting, though, that they maintained their EPS forecast. So faster top-line growth isn't necessarily translating into faster bottom-line growth. Analysts today, though, saying that likely is just an additional cushion given the inflationary cost pressures these guys are facing. Now, another point worth making here, yes, the company topped estimates in the second quarter, revenue up 5.2% overall, but unit volumes actually trailed that gain. Frito-Lay North America volumes, for example, actually down about 2%. So that indicates most of the sales gains came from higher prices, with prices up 12% across products as the company passed on some of that elevated input cost that it's facing. And then the ability to exercise that pricing power is really the differentiator in the consumer-facing sectors as the consumer maybe shifts its spending patterns in the face of inflation and fear of a recession. Now, Pepsi obviously falls into the staples category, a group that has held up far better than the discretionary sector this year. Discretionary, the worst performer in the S&P 500, down 30% year to date, John.
What do you make of that double punch on Europe, Kaylee? You get the FX story plus the weakness in the economy.
Yeah, it's a brutal one. The European, any company, multinational company in the U.S. that has to do business over there and is dealing with these FX headwinds as well, probably going to be a big theme, not just for Pepsi, but really across the board, John.
This is tough. Kaylee, thank you. Great word this morning over the foreign exchange story. Euro dollar, you're getting hammered twice on the translation from euros back to dollars, and then the weakness that you get in the European economy right now too. Just on the energy story, not in Europe but in the US, Bank of America put out their card spending data in the last 12 hours or so, last 24 hours. This is what they had to say. Gasoline spending rose another 4% in June. These were month-on-month figures. It's up over 20% over the last 5 months or so. They say this has started to take a toll on other categories of consumer spending, including services. Spending on travel and restaurants fell for the first time since January. And you all remember what happened in January. That was the peak of Omicron. Back with us, BlackRock's Jean Bavin. Jean, help me here. The relationship between what is happening with energy, the price of energy, the cost of gas, fuel, all of the above, and what's going to happen with consumer discretionary.
Yeah, so that's I think there's a difference between Europe and the US here that we want to make clear at the outset. I think it's a big deal for Europe. You talked about the exchange rate here, weakening euro. You know, we're talking about a shock for Europe that is of the magnitude of the 1970s. It's going to hurt the consumers there the same way it has in the 70s. That's why I think recession is kind of, you know, the baseline for the euro area as a whole. It's working through the consumers, the impact it's going to have on their purchasing power and so on. For the U.S., it is a headwind. It is something that is slowing down. On its own, I don't think would be enough to create like a real material slowdown, you know, purely from the demand destruction or consumer side. It's really that, but more the combination of that with the Fed aggressive hiking campaign, which eventually we think they'll pause and reconsider. But for now, they're pretty much on autopilot until the end of the year. And that's where the slowdown is coming from. But so the energy story is really, for us, more of a European story. And I think it plays into the euro-dollar exchange rate story you started with.
Jean, can we just focus on Europe a little bit more and get away from the mainland continent and get over to the UK? What we saw at Heathrow Airport today, putting a cap, a limit on passengers going through that airport and telling the airlines, that's it. Don't sell any more tickets this summer. Jean, I can't help but think that's not the end of that story. That in Europe, they're going to make some tough decisions about what should happen with capacity because of labour market constraints in places like airports, but also because of energy needs. Jean, what are you anticipating on the latter, on that front, on energy needs and the restraints, the capacity constraints that governments might start putting on these economies?
I think this speaks exactly to the core point of this environment is not the one we had, over the last 40 years. We're talking about, the airport example is perfect. We're talking about a situation where we're not able to ramp up activity the way we used to be able to do normally. It's not like there's an unusual amount of flight that needs to go out of Heathrow. We're just not able to go back to where we used to be able to. And the reason being, as you say, labor supply. It's the labor shortage that is really preventing that from happening. So that is an anecdote that tells you the broader story that's going to take time to resolve. And by the way, this is also why this is not like this kind of logic of recession will ease off the inflationary pressure. We don't see that as the natural way to think about this. It's going to be production constraints that are so strong and hard that they keep putting inflation pressure at the same time as we see struggle to ramp up activity or even decline activity. So that's going to eventually, I think, ease up the pressure on commodities and oil and energy to some extent, but that's not the cause of it. So I see that more as a slight offset compared to the clamp down on supply that is happening through the geopolitical landscape and situation. So it's a small offset, but I don't think it changed the broader pressure upward on energy that we're facing
Jean, we've
globally.
just had a pretty long conversation, and I imagine sitting at home, I'm thinking of the S word right now, and I don't believe either of us have said it. Stagflation. Haven't you just described that in Europe?
Yeah, I mean, I think the stagflation or, end of greater moderation is what we're talking about. Exactly. So we're going to see a combination of inflation pressure continuing while growth is slowing. And that combination is one that central bank cannot stabilize as effectively as they've been able to for the last 40 years. And that's why either we're going to see a bit more inflation, somewhat more inflation, and that's going to be bad for bonds, or we're going to see more growth volatility, weaker growth, and that's going to be bad for equities. And that's kind of the more volatile environment that we are now living through and we haven't experienced for 4 years.
Jean, it's been great to catch up, as always, sir. Jean Bavin of BlackRock on the latest on the equity market and a whole lot more for the outlook this year. We're positive 0.1% on the S&P, on the NASDAQ, up around about 0.2. Coming up your trading diary, CPI tomorrow, then it's on to the earnings story. That's next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
We are about 25 minutes into the session. Equities look a little something like this. Positive 1/10% on the S&P 500. On the NASDAQ 100, positive by a little more than 1/10%. That's the price action. Let's get to your trading diary. The President speaking at 11:15 Eastern Time. I host the Fed Speak throughout the week with Barkin, Bostic, Bullard all on deck. US CPI out tomorrow. Then the President heading to the Middle East. The big banks kicking off earnings on Thursday with JP Morgan and Morgan Stanley. US PPI and another round of jobless claims coming up. Finally, consumer sentiment and US retail sales are out on Friday. We've got a busy week coming up. Looking forward to covering that with you. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down